Where do you find earnings at? There are several sites you can find earnings at. You can go to our website, and if you click on market data, and then you go over here, there's this particular tab, which is called our market calendars. You can come down here, and we have what's called a stock point earnings calendar. And basically what it does is you type in the stock symbol, and it gives you the next earnings date. It'll either give you the next earnings date or it'll give you the previous earnings date. Now, someone help me out here. If I can't find out what the next earnings date is, but I have the previous earnings date, is that a problem? Yeah, if you know, today's what, the 22nd. If I bring up XYZ and it says June 15th as an earnings date, and I go, well, gosh, June 15th. July 15th, August 15th, September 15th. There's how you find, I mean, we don't have to be rocket scientists. We don't need the exact day for earnings. We just need an idea where earnings are going to come in. So that's how I use the earnings filter. Yes, ma'am. What about dividends? There's an economic calendar. I believe there's a dividend calendar built into that area too. It's on the website. And if you have any other questions on the website, I'm going to do a little demo this afternoon on it. It's going to be a little bit more broad. Just try to keep your questions to straddles right now. Yes, sir.
A lot of companies are giving guidance ahead of their earnings now. Does that ever impair your strategy?
Good question. And normally when they put their guidance in is 3 to 4 weeks ahead of earnings, which is perfect. Because we don't know when that's going to happen, but we know it happens usually no more than 30 days out. Because these guys, what they'll do is when their books close, they usually report somewhere between another 15 to 30 days later. They won't have guidance until the end of the month, until they get that final number in. So very good question. And does it impair it? No, actually, if it's funny, we get more movement off of the warnings than we do off the actual earnings report itself. If most of these guys would just clam up and not say anything, they wouldn't have half the problems that they do. But they have to say something, because if they find out something that could impair their company's earnings, that's an adverse material effect, and they have to disclose. If they're going to peek at their numbers, they got to squeak if they see something that's a little off. Yes, sir.
Would an index option or a sector be generally too expensive to straddle on?
Okay, I have done index options on them. I'm going to show you an example of one that I do almost every year, and it is the one I do costs about $4,000 per straddle to do, and that's cheap. So the answer now I'll tell you how you can get them cheaper. The QQQ is going to be the cheapest straddle you'll ever find as a sector straddle. You can do those probably for about 5 or 6 points, which are around $500 or $600. I do them on the OEX, and I'll explain why in just a moment. I'm going to show you an example of that here very shortly. Calling it in. If you to call a straddle in, I do have to do exit strategies with you too, so just bear with me on this. I want to talk about calling it in. I want to talk about, I want to give you a couple of case studies. I want to show you exit strategies, and I've got a real-time trade. I think I have two. I want to check the other one, though, during lunchtime, just to make sure that it looks fine. But to call in a straddle, if the stock is XYZ, expiration month is January, strike price is 50, total cost is 6, how do I call this in? Here's my order. This is a straddle. I want to buy 1 XYZ January 50 call, 1 XYZ January 50 put for a debit of 6, opening both sides. Okay? I'm not telling them I want to buy the call for 3 and I want to buy the put for 3. If I do that, chances are I'm only going to get one side of the position. Okay? I'm telling them I want the whole thing for a debit of 6. Now, there's another way to call this order in, too, and that's simply to say that you want to buy the XYZ January 50 straddle instead of saying the call and the put. Okay? Opening both sides. If you key this in, if you're using a broker that has a spread order platform, such as Wall Street Access, if you key this in, then what you're going to wind up with is they'll have a screen where you put the calls in and you put the puts in, and you have to put it in for one price, and you put it in for your debit of both the calls and the puts, and you then just click the order button. That's it. Here's some examples I want to show you. This is a stock that we did a while back called APCC. APCC is American Power Conversion Corp. All right, they make those backup batteries that all of us have been getting for our computers. They're one of the guys that make the backup batteries. When the year 2000 rolled around, you couldn't get these guys on the phone because everybody's so worried about the power going out that everyone was buying batteries off these guys like there was no tomorrow. APCC, as you can see, had a consolidating market. That little line below was actually implied volatility too, so it was cheap also. And as you can see, what's kind of happened here, APCC broke out of its range. Now, you got to look a little closer because it's not up here, guys. There's that one little bar down here, it's gapped down. Okay? Boom. Looks like the power went out over at APCC. Bang, bad earnings. It's amazing. How can these guys get bad earnings when they had such a good year, with the Y2K? It's easy. People stopped calling after the lights still worked on January 2nd. This was a straddle that was done for $900. This, my average straddle, guys, is costing around $600 or $700. That's for the call and the put combined. This one was a little more expensive. It costed $9, but then the stock dropped $20. So here's what happened: the calls went to zero because they will. If you go from an at the money to 20 points out of the money that fast, calls will basically be worthless. I think they were zero bid and maybe 10 cents offer, which means anybody that was a fool that wanted to buy them for 10 cents could, but you couldn't sell the ones you had. The puts were worth $18.25. This had a cost of $900, a profit of $18.25. Okay, so you can see how this one worked. And sometimes I get them where they hammer real hard, and sometimes I get them where they move out of the range. They don't gap down. I'm going to show you a few more. This is SRV. Okay, nice consolidation. SRV, a real nice tech company. You know what these folks do? Funeral homes. Okay, they're not in the tech business. They gobble up funeral homes. They basically buy them. They're a company that just buys up funeral homes to make their own balance sheet look better. Well, they did a survey last year, and their survey basically was the effects that new medications and technology have on human life. Okay, what they found out was people were living longer. Okay, they had to report that because that's an adverse effect on their earnings. So when you come out and you're a funeral home company and you say that people are living longer, what's that going to do to your stock price? It's going to kill it. All right, so, once again, I mean, these will happen sometimes where you can get in, and, the gentleman over here in the back said, will something, could a possible guidance cause a problem? And this is really an idea of guidance where it came out long before the earnings, about 3 or 4 weeks before the earnings report, because we were only in this trade for about 6 days. These are the kind of things that we like, is that, there's every once in a while you're going to get a grand slam and you're not even going to know it. It's just going to happen. Okay, that was a yield of over 200%. It's 220% actually. The guidance came out 6 days after I placed my straddle. Yeah, if it comes out before, it won't make my list. Because, number one, it won't be consolidating anymore, right? Number two, the options are not going to be cheap anymore. And number three, you might as well forget about the earnings because it's going to do nothing but go down. Yes, sir?
What risk-reward ratio should you do?
I'm going to show you that in just a moment. But it's not 3 to 1. Okay, it's a lot less and the reason why is because you're buying a call and a put at the same strike price. And that's, straddle is the most expensive spread that's out there. This one right here is an example. This was the OEX. Okay, now this one was a year and a half ago, and the reason I picked a year and a half ago was because last year, what happened come October. If you'd have done this in October, you'd have missed the big move that happened in September. I mean, that surprised everybody what happened in September. But the year before, I'm showing you one, and you got to take yourself back to the year before. Okay, who was in office a year before? Bill Clinton, and everything was great. Remember? Globally, we were a mess, but in the U.S., everything was great. This right here showed the markets were moving up nice and slow. We didn't have any wartime, obviously. Implied volatility was real cheap. Guess what happened to the VIX up there at that point? The VIX went where? Below 20. So instead of deciding to buy a puts or buy calls, we went in and just bought straddles, and that was the result. Boom, right back down. Now, I'm going to tell you this. Where do you think we got out at? Down here? No. I got out somewhere around here. I missed half the move on. I got out as soon as it stopped moving down because it hit an exit target. My exit target is I want to get out with a 50% profit. not a 3-to-1, a 50% profit, because guess what? I'm not looking for market direction, and because I'm paying for this call and put at the same time, I can't possibly, in most cases, look to get more. I find 50% seems to be the norm. Now, every once in a while, we'll get one of those grand slams that happens, and that's great. But this is an example of one that that made $2,300 per straddle. It was a great straddle. You'll pay more, but you expect to get more on these larger straddles. Now, I want to talk about exit rules. We talked about getting in. We've talked about different filters. Let's talk about getting out. These are 3 exit rules that I want you to make sure you have if you're going to trade straddles. First one is exit 30 days to expiration, or around an earnings report. Now, let's say your earnings report's coming out in 3 weeks and you place your straddle. You're going to exit when? In 3 weeks or in 30 days to expiration? Well, when the earnings report comes out, isn't the market more than likely going to move? Yes, and that's the time when you want to think about exiting. Is that I normally exit around the earnings report. Now, I say around the earnings report, so let me get more specific. Is there a way we can go back in time and find out whether certain stocks move before earnings or after earnings? Yes. Optionetics.com. Okay? Go back and you can pull a chart up, and I'll show you exactly how to do it. You can go and pull a chart up on our website. You just simply go to the Market Data tab at the top, and I'll type in, here's a stock symbol that's close to home. Now, those are, look at that comeback, guys. Well, then I have to type the stock symbol in. Yahoo! Yahoo! Okay, so let's go to chart. Oh, I got Yahoo, huh? Okay, 1Y. Okay, Yahoo. Yahoo's at $13. I really want to see the chart, so I'm going to click on chart, click Get Data. Now, when I bring this chart up, down below, there's an area where I can click in earnings. There's also dividends and splits and all kinds of neat stuff. Sorry, guys, there's not Elliott Wave on here. They're not that sophisticated. But what I will do is also I'll bring up the huge chart, and let's see the earnings dates. I'm missing my earnings dates. What did I do? Now, what should happen is I should have E's on here, and I should be able to see exactly when the last earnings are. You can also go to Yahoo, and you can get this as well. But you bring a chart up, and it's going to show you where the earnings dates are. And then what you can simply do is just look and see, did the move come a couple of days before earnings, or did it come a couple of days after earnings? And then, by knowing that, you will know this. Exit around the earnings report. Means if the stock you're in question is moving a lot, then that's great. If it's not moving a lot, then before earnings, or after earnings, if it moves before earnings, you get out before earnings. If it moves after earnings, you got to wait and go through earnings. Exit for a 50% profit. If I put a straddle on for 10, what am I getting out at? Not 5. That's a 50% loss. 15 for a 5-point profit. I know what you're saying. Now, I also have something called the big move stop. You guys know what the big move stop is? I showed you 2 examples. If something like APCC, you get a big move, you get out of it that day. If SRV makes a big move, you get out of it that day. Anytime there's a move that causes volatility to move up considerably, consider it your ability to get out for better than sticker price. Okay? That's what I mean. Here's an example. Boeing. Okay? Boeing, do you know Boeing's earnings? No, you don't. Neither do I. Okay? You know who knows Boeing's earnings better than anybody besides Boeing? The government. Analysts definitely don't know Boeing's earnings because they can't seem to hit the mark because there's so many top secret things going on over there. They can't possibly know what's going to happen. So Boeing is one of those stocks that moves before earnings. It constantly moves before earnings. So if you got consolidation and you got cheap options and you got an earnings report coming out and you look at the last 4 quarters and saw what happened, you'd know I need to be out a couple of days before earnings because that's when the big move is going to come. There are some stocks that don't move at all until right when the earnings date comes out itself, and then that tells you, well, okay, I need to be in it a couple of days after. So the best thing that I do is I look at pattern recognition, and I try to recognize what did that stock do the last 3 or 4 earnings. That's the best way I can explain it to you. That's how I use it. Let's look at a recap, guys. I've shown you 3 systems for trading straddles. You don't have to use the earnings report. You can use consolidation. You can use cheap options. You can use earnings. We've looked at high probability of limited risk and unlimited returns on options. We looked at objective entry and exit rules because you will get out one of those three exit rules. There's just no other way. If you're staying in it, then you didn't follow the rules. Now, I want to talk about how to become a better straddle finder, meaning how can you, for those of you, who's doing straddles in here right now? Okay? Straddles, contrary to popular opinion, can be a very good way to trade if you follow the rules. And so one of the things we can do is we can look at possibly putting together our system on a regular basis and trading it. One of the things we do is we put out a publication called Straddle Finder. I had them pass out a blue sheet so you can see what it is. This was a recent copy. I'm going to show you what our trade is here today in just a few slides. But what we do is we basically, as you can see here on the screen, and this is the way it would look if it came on your computer because it comes down in Adobe Acrobat format, so you can actually print it out in color. The black line is actually the price of the stock. The red line is the options implied volatility, as you can see in nearly every case. In every case, we're below that. We're at the bottom 20%. In this particular one, we were actually down on the lows. We were down to 0%. Okay, this was one we just did just 2 months ago. So how has our trades been? This is basically what we've been getting over the we've been doing straddles now since 1997, so this is now our 5th year trading straddles through actually putting them out in a premium publication. Our average is 30% return per trade. 70% of our trades have been profitable. Our average trade has been cost is about $600, like I said. That means sometimes it's a little more, sometimes this week it's a little less. I've got one that's around $3. I think it's $3 to $3.50 is what we're looking at today on this one particular trade. Average time in a straddle is only 21 days in the last 5 years. That means that, you know what? That means that, yes, we normally put it on expecting in 30 days to be out of it, but then you'll get that 5 or 6 dayer that comes along. You get that big move, that there was a warning or something, you're out. So our average time in these trades is about 21 days. So, here's a difference. Leap options. How long do you expect to be in a leap option for? A long time, right? If you put a leap option, let's say you decide you're going to look at trades on a weekly basis. You put on enough leap options, at some point in your career, what's going to happen? You're going to run out of something, right? Yeah, because a leap option is a long-term trade. So it's best to mix your options positions up. And some things you can do are shorter-term trades. This is a real good income-generating trade in so much that you're always you're turning cash flow over. The example I'm showing you now is what's called portfolio rollover. If you decided, let's say you were going to take a straddle trade or a short-term trade every week, and by week 3 you're taking off the first trade, by week 4 you're taking off the second trade, and what you're doing is replacing every week. That's where portfolio rollover comes into, and it also keeps cash on hand as each week comes by and you find more trades. So here's our real-time trade for today. Pacific Sunwear. The symbol is PSUN. All right, nice low volatility. Stock's moved in a 15-point range. There's been some nice profit and movements around the earnings date. Now, this is an interesting one right here. Here's your trade. I'm going to buy the September 20 calls. The stock's trading right around 20. Buy the Sep 20 calls. Buy the Sep 20 puts. Debit of $3.30. Opening both sides. Okay? If we do get a 15-point range to continue, this is actually quite a bit more than we would be expecting for a straddle like this. So this is a cheap straddle. It's a lot cheaper than our average. Our average is 6 points. This one's at $3.30. Now, remember our exit strategies. Okay? What are our exit strategies? 50% profit, or 30 days before expiration, or around earnings. When is earnings coming out for Pacific Sunwear? Anybody know? I got to back up. Look. August 12th. There we go. So in 3 weeks, earnings are coming out. So how long do you think I'm going to stay in this straddle? Until September? How many of you say, yeah, until September? If you said yes, you weren't listening. All right? Wake up. How many of you say, somewhere around August 12th? There you go. It's a 3-week trade. Basically a 3-week trade, okay? Now, down at the bottom it says this order is good for the week only. We put these out on a weekly basis, and that basically means that if I don't get filled today, you know what I'm going to do? I'm going to place it tomorrow. If I don't get filled tomorrow, I'm going to place it Wednesday, Thursday, Friday. If I don't get filled by Friday, I'm going to reevaluate the trade. And what we do is, George and myself and our guys reevaluate these trades each week. And if we see something that's getting filled, great. And if we see something that's not getting filled, we reevaluate it. We might place the order again next week, or maybe we move on to something bigger and better that's developing. The last thing I wanted to talk about was, this is something, we're just about ready to go to lunch. You want to do a quick key market update since things actually turned around?
Well, while Tom was speaking, I was up there looking at a neurotic market as usual. Basically, I'm calling around the trading floors and the trading desk, and what happens is, we talked about it earlier, that program trading limits. What happens is, they at a certain point when the Dow's, I think the number is now up or down 180 points right now, they stop the people from hitting these computers. So basically it went down, the Dow was down almost 300 points on its low. You see down there at the very bottom, there's 7,700 on the Dow. That was down 300 points, which is where obviously you can see a lot of buying came in. And now what we've done is we actually were up roughly 30 points just like a minute ago. And now we're down 20 points. Can you kind of see that it's a little neurotic here? Unbelievable. So if you're sitting around watching this day in and day out, you can see why I'm going to be in a funny farm in about a year or so. Because you can only, I think 15 years is the point at which you can't look at this anymore and your brain just, but I mean, this is what you look at. And the reason I look at this, and if you go to work and you come back, I'm looking at eSignal here, which is a charting service or whatever. It's good to look at the intraday, what the prices are doing intraday, because you can kind of see the personality of a market. I mean, the personality of this is, Dr. Jekyll, Mr. Hyde type stuff. So it's one of these crazy things. So this market right here could easily be up 200 points at the end of the day or down 300 points again. And we're talking about just, a few hours to go. But I mean, this is one of those markets that when you get this kind of massive volatility, it means there's lots of confusion. When you get volatility, volatility just means confusion of where price should be. So what's happening is a lot of buyers are fighting with the sellers, and the sellers are fighting with the buyers. And this very well, I mean, I personally don't think we've seen the bottom yet because the washout hasn't hit, but it's coming close because we're starting to see this. It's kind of like living in Miami and watching the Weather Channel and watching a hurricane coming towards you, trying to figure out when it's going to hit and whether you need to evacuate. But it's pretty much, you can see that the market is very schizophrenic right now. Actually, the one stock that's actually held up really well throughout the day, and I've been watching that, was Intel. Even when the market was down 300 points, Intel really was holding real well, around even for the day. So actually, when you start looking at that as a trader, what you should be thinking is, well, if the market does turn around, Intel could have a good pop, okay? Because if a stock is not getting hit hard while the market's down 300 points, it's actually holding up well. So the premise would be, if the market starts to shoot up, it'll take that one with it. It's kind of like riding a wave. And that's one of the things I look for. I look for stocks that are holding up well or are strong in a weak market, or you look for stocks that are basically falling apart while the market is still making a good run up. We'll do an intraday of the VIX. The volatility index on the S&P 100, okay, these are kind of a point charts. You can kind of see it's swinging all over the place. So intraday volatility moves. You can see when the VIX is coming down, what's happening is basically, these are like actually price points at which it made a price point. When the VIX is coming down, the market is doing what? It's going up. Remember? And the market's going down, the volatility index is going up. So it's an inverse relationship. So, but once again, I mean, within, just so you know, within each individual stock, the way the floor traders work is they have a computer program on their desk that changes the volatility assumptions very rapidly. Because if all of a sudden Intel starts to run up, they start bringing the volatility down. If Intel starts to go down, they start bringing the volatility up. You're not going to know that in most cases. It's hard to tell until, like, at the end of the day, we update our data. Or you have some very sophisticated, options trading programs that have real-time volatility assumptions. You don't need that. They're very expensive. I do have one that they use on the floor traders use. But let me tell you, it's very expensive, and a lot of times it's wrong. I mean, you ask it for data, the data's wrong, and it's just one of those things you realize after many years. So it's a very interesting market today. I'm sorry, I can't hear. Oh, the H, the column H, just so you know, this is, let me repeat, this is eSignal, which is a data source. These are real-time quotes. The H column is headlines, news reports that are out there. So if you look at AOL there, it says there are 47 news reports. I can click on that 47 and it will give me the headlines. It'll say AOL did this, AOL did that, AOL did whatever. So once again, you know, as I scan what the market is doing, you know, right now it's very neurotic. We could easily be down big again, and or we could be up big. I have no clue. This is the beauty of trading options, that if you do your job right, you're not going to get hurt in either direction. So you know, I want you guys to understand that you're not at a disadvantage if you can't watch this all day. In fact, you're probably going to save some of your sanity, you know, if you don't do this. Most of my trading analysis is done at night, believe it or not. As soon as the market closes, I can now start looking as to what I'm going to do tomorrow. I then know exactly what I'm going to do the very next morning, and I make my decisions. My decisions, I don't want to act under fire, so to speak. You know, when the market's moving fast, boom, 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 and you're making quick decisions, you can make a lot of mistakes. So it's better off to make the analysis while the market is closed, actually. So other than that, I'm going to hand this over to Tom, but I'll keep an eye on this, and we'll see what happens throughout the day. Be interesting to see.
Okay, guys, before I send you to lunch, I've had a lot of people asking about some of the products we have in the back of the room, and you know, we don't have it back there unless we think it's going to be some good value for you. That's something that we've been doing since the beginning of time, is where can we help create value for our traders, get them up to speed faster, and get them trading like we're trading. We have 4 different publications that you see here. These are publications we started, actually the first one we started was WealthWire Stocks several years ago. We have 2 non-directional publications, which are straddle finders, which are straddles, calendar finder, I'm going to talk about that after lunch when I do calendars, and option finder, which is a brand new one we started this year. The returns we've had have been really good. In fact, every one of them have had great returns since inception. This was last year's returns on WealthWire Stocks. Calendar finders, like I said, we've had a long-term returns on those, very good winners. There are times when, you know, like an example, Pete made a good comment, and as sometimes straddles are too expensive to trade. You know, and I've had example my straddle trades where I flatlined for a month. Why would I flatline for a month? Because I couldn't get anything filled. I couldn't do anything. So in that turn, you know, if straddles aren't working, there's got to be something else out there that you're getting an abundance of. And that's basically calendar spreads. I mean, because if volatility is high, you'll find less straddles, but you'll find more calendars. If volatility is low, you'll find more straddles, you'll find less calendars. Calendar finder, our last year's returns were 220%. It's been one of our best return strategies of any of them, because look what the markets have been doing the last year. Other than going down, a lot of those tech stocks, which are great calendar spreads, have been moving where? They look like they're flatlining. I mean, you know, if I saw some of these graphs at a hospital, I'd have to put a sheet over the patient. But they make great calendar spreads. And like I said, with Option Finder, we're doing really well this year. It's the first year we've ever put this out. You know, George and I, over the last 10 years, this is probably the best time to be trading just calls and puts. Because what has happened that hasn't happened before? Well, you know, a couple of years ago, Broadcom was a $200 stock. Imagine just buying a call option. You were paying 30 to 40 points for just a call option. Okay? Now, with the exception of the last 2 weeks, everything's real cheap, but the implied volatilities are real low too, and it made good sense to actually get out there and buy calls and puts on certain issues. And that's what we found. And we found this is actually becoming one of our best publications in terms of short-term returns.
This completes CD number 12 of the Optionetics course audio series. Let's review some of the most important points covered on this tape. A straddle is one of the most popular delta-neutral strategies. Straddles are composed of the purchase of an at-the-money call and an at-the-money put with the same expiration. Make sure the options have at least 60 days or more until expiration. As a non-directional low-volatility strategy, a straddle offers limited risk and unlimited rewards, regardless of market direction. The upside break-even is calculated by adding the net debit of the 2 options to the strike price. Conversely, the downside break-even is calculated by subtracting the net debit of the 2 options from the strike price. Making a profit on a straddle does not depend on accurately forecasting market direction. It relies on a big enough move in the underlying market in either direction. which is why it's so important to buy low volatility or underpriced options. The risk graph of a straddle resembles a smile until it hits expiration, and then it looks more like a V. The V represents the non-directional bias of the trade by showing the potential a straddle has to make a profit in either direction. Finding promising markets for straddles involves looking for consolidating markets, cheap options, or news and upcoming events, like earning reports, that could inspire big moves in either direction. A market that is consolidating will have a price trend that resembles a triangle or wedge. The tighter the wedge, the greater the expected move. As it approaches the apex of the triangle, it may easily explode in one direction or the other. A good way to find consolidating markets is to use an average directional index, or ADX, which tells you whether the particular chart in question is trending or not. To look for cheap options, you need to understand the concept of implied volatility. First, volatility is defined as a measure of the amount by which an underlying stock is expected to fluctuate in a given period of time. The more the market moves, the higher the volatility of the market. There are two main techniques used to measure volatility: historical and implied. Historical volatility is defined as a measurement of how much a contract's price has fluctuated in the past over a specific period of time. Statistical volatility and other measures of historical volatility can be used to gauge whether a stock has been trading quietly and in a narrow range, or erratically with wide swings and large price movements. Implied volatility reflects the market's expectations concerning future volatility. It is a product of an option pricing model, such as Black-Scholes pricing model, and is expressed as a percentage. Each option has a unique implied volatility. Two options on the same stock with different expiration dates and/or strike prices will not necessarily have the same levels of implied volatility. Implied volatility is always in a state of change. Bottom line, strong interest in an option contract will force prices higher because investors are willing to pay more for it. Conversely, as interest in an option wanes, so does its implied volatility and ultimately its price. To find out whether an option is cheap or expensive, compare the implied volatility of an option to the underlying stock or index's historical volatility. Then, look at the implied volatility of an option over time. There are 3 exit rules for trading straddles. 1. Exit 30 days to expiration. 2. Exit around an earnings report. And 3. Exit for a 50% profit. Finally, Tom reviewed various publications created and written by the team of traders at Optionetics. 1. WealthWire Stocks. 2. Straddle Finder. 3. Calendar Finder. And 4. Option Finder. All of these newsletters have been making excellent returns over the year. They are available to all our Optionetics students. For more information, call the Optionetics main office toll-free at 888-366-8264. That's 888-366-8264. This concludes CD number 12 of the Optionetics course audio series. When you're ready, please insert CD number 13. CD number 13. Tracking the Sideways Market. Welcome to CD number 13 of the Optionetics course audio series. In this session, George Fontenelles and Tom Gentile invite the class to attend the Advanced Optionetics seminar, and then take the rest of the session to discuss butterfly spreads and calendar spreads, option strategies that are best applied in sideways moving markets.
Well, during lunchtime, the market was still oscillating wildly. It had gone from, I know a lot of guys were watching it, we were down about 170 about 10 minutes ago. And so we've gone from minus 300 to up 30 to minus 170. I just saw it at minus 80. Now we're at minus 128. This is called volatility, by the way, guys. You know, so there's just no telling where this thing's going to go. Like I said, I mean, we can easily be down tremendously at the end of the day, or we could be up. Who knows anymore? And that's why a lot of people say this is just too tough of a market to be a stock buyer. Now, this is what traders deal with every single day. I mean, when you're on the floor of a stock exchange trading, this volatility, you know, you see, I haven't seen this in a long time, honestly. I mean, it's just rare. This is rare to see, but it's usually the very end of a move. Whenever you see volatility coming in. So high volatility usually means the end of a move because so many people are changing their places. So many sellers are coming in, the buyers are coming in, the sellers coming in, the buyers coming in. That's why they keep saying they're waiting for this capitulation. They want to wipe out all the people who have weak hands. What a weak hand typically means is the retail buyer, you know, the individual investor, where the strong hands are the mutual funds, and the only reason they have strong hands is because it's not their money, right? If you really think about it, I mean, that's the reality of it. It's just they're investing other people's money. It's not their money. Therefore, hey, what the heck? I can do whatever I got to do. So,
What do mutual fund investors do in a market like this?
what do mutual fund investors do in a market like this? Cry, okay? Basically, you know, there's bond funds and people can move their cash around. What's been happening is money's been flowing out of cash or the stock funds and going into the bond funds because people feel safer getting, 4, 5, 6% return. I mean, there's a group of people out there. I mean, how many people can just keep on losing money? At one point, you just gotta. People are going to give up, which is what the markets are waiting for. That's what the quote, the smart money, which is, supposedly the mutual funds are going to come in and do. They're kind of just waiting for these markets just to keep bottoming, which is going to mean that everyone's just going to get wiped out, and then it's time to start buying. Because what truly happens at the end of a move is that it's usually people just give up, I can't take it anymore. Then the money, smart money or the mutual funds start buying it, hopefully reduce prices, or they do what's called dollar cost averaging. They got a stock at 50, now it's at 4. Maybe we should buy some more at 4 and bring our cost basis down. It's amazing, it really is amazing the things that we're seeing these days in the market. I just want you to realize that, I know a lot of you are relatively new to the options market. I saw your hands come up yesterday. And I don't want you to be afraid of what you see here. In fact, this should be exciting because this is where the opportunity lies. The opportunity lies in the markets moving up and down and moving up and down. The next 3 years, the markets may very well move between 10,000 and 7,000. Just move up and down and up and down and up and down. And someone who's in a stock will be at 0 at the end of all this, where you could have had a really good return by being able to trade the oscillations. And that's kind of what we do as traders ourselves. I'm going to hand this over to Tom in a second. Tom's going to do calendar spreads, which I just want to note to you that is one of my favorite things to do, a calendar spread. Now, the one thing you're going to note here is you're going to see a calendar spread, which is a basic version of a calendar spread. If by chance you guys can make it to our advanced seminars in Vegas, when you see the seminar special offers, if you can ever make it to this class, it's an unbelievable class. It's actually the one class that Tom and I always teach together, and we bring in some of our best instructors to sit there and teach you different things. For example, we'll have one day only on calendar spreads. We have to do an entire day of calendar spreads. So if you like calendar spreads today, if you can make them to Las Vegas, what we do is we do special versions of calendar spreads, and then we're going to show you how to trade calendar spreads, add some other types of trades on top of that, add another type of trade on top of that. You're going to see some of the funkiest trades that were ever invented because we've invented those. We even have the Tarzan Loves Jane trade, okay? Which we warn you, don't call your broker and say, I'm going to do a Tarzan Loves Jane trade. Because most brokers do not know what you're talking about. But in essence, if you can make it to Las Vegas, and if you see, we created a package, which we call the C package here, primarily because, when we developed this class 10 years ago, people came to us and said, I've been to a number of 2-day seminars. What can you do next? What can you do next? What can you do next? And Tom and I look at each other and say, well, what can we do next? And so we developed this, the C package, which is kind of like our PhD MBA version of taking everything you can, which includes everything under the A package, which includes all the advanced GET stuff, the B package. Then the C package is you get to come to 2 advanced seminars. The 2 advanced seminars, one's in Las Vegas. What we do is we have around 60 people or so, and we put you in round tables. And what we do is we teach a concept. Tom, myself, and the other instructors, we go around and we listen to what each table is doing, because we're kind of like a fly on the wall. We want to know if your thinking process is correct. So I'll have each team debate with each other in a group, and then I'll have the teams come up with the best solutions they can, and then we try to find the best solution. What we're trying to do is create a thinking process, where by the third day, I want you to be thinking like myself or Tom. Now, that's a good thing when we're talking about trading. Everything else, forget. But, when it's trading related, we know this stuff pretty well, as you can probably tell. And what we try to do is give you as much information as we can. We do not hold anything back, meaning I promise you that if I make money doing something, you'll learn about it. I am not going to hold anything back. You will know, if you can make it to Vegas, everything that I do. And, we trade very large size, and the only reason I can trade very large size is because I know how to limit the risk really, really well. On top of that, we just taught at this one in Vegas, an aggressive short-term trading strategies too, on how to make money on short-term trades and then keep your longer-term trades kind of as a portfolio. And it's worked out really, really well for everybody who attended. We do it in Las Vegas primarily because people like to go to Las Vegas. And on top of that, we're going to give you a special gift. We are going to tell you the best buffets to eat at, okay? We have inside information. No, but we just did one at the Hard Rock Hotel in Las Vegas, and it was really a lot of fun because, after class, Tom and we would have personal consultations in the pool, only if you bought us margaritas. Okay, if you bought a margarita, you could talk to us. So the one we're going to do coming up in October, and you guys will see that we have an October one coming up, October 9th, 10th, and 11th in Las Vegas. It's at the Venetian Hotel, which is a really nice place. Okay, so the Venetian, Tom and I are going to kind of decide which hotels we want to stay at, and then you guys can come out and hang out with us because that's where we want to be. But really what I want to tell you is, I get the question, when are you ready for it? If you want to go, let's put it this way, you're probably going up 7 years of my life as a trader here. If you want to go to my 14th year, that's what you're going to learn at this class. And if somebody had given me this information, and I can tell you, when people walk out of our advanced classes, they are smarter than most traders on Wall Street. Because most traders on Wall Street have no idea what we do. And what we want you to do is get up the learning curve as fast as possible, go up to the pinnacle of learning as fast as you can, because you go through 4 years of college or whatever, or 6 years or 8 years to get to a point. We want to do this. Basically, we want you to do it in these 2 days. We want you to then go to our Vegas class, which is 3 more days and 5 days. If you can then make it to our computer class, which the C Complete Trader lets you to do, you basically in 9 or 10 days, you have more information than most professional traders have. Now, why is that important to us? Because bottom line is, to get to the level that we want you to get to, we have spent ridiculous sums of money. I mean, ridiculous sums of money. In essence, to give you the knowledge we have here, we have spent millions and millions of dollars, obviously, to give you all this information. But, I personally, I think, and Tom too, our goal is to have the most successful traders out there. And it's actually kind of fun, and people always ask us why we do this. It is actually fun to walk around. It happens all the time. I was just in Miami at a restaurant the other day. I had somebody come up and, "You're George Fontenelle." Yeah, it's kind of cool to have that happen. I mean, or people say, "Hey, I'm one of your students. I didn't want to talk in front of the class. You changed my life." I had one guy recently tell me about his son who just went to college, and his son is teaching his professors about trading. We have one of our instructors, Mitch Genzer, who it's kind of funny. He told us about his daughter. His daughter's about 6 years old or something. And his daughter goes to parties and says, "Can you believe what Cisco's doing today?" We had one, I think it was a 13-year-old, 14-year-old in one of our advanced classes. And I couldn't believe this kid. He was sitting there at a table with 8 people telling them, "Do this, do this, do this." And I'm really impressed. So, what I want you guys to do is just realize that our job here is to give you information as fast as possible, as much as you can absorb. And the bottom line is that, when we create a product or do this or do whatever, it's not because Tom and I need the money. That's not the case. The bottom line is, you guys are in a new university. You're in a new college. You're trying to train yourself for a new career. Could be the most profitable career you could ever do. It's better than being an athlete, because the bottom line is you can do it for the rest of your life. Okay, so you're trying to get to a level where your life can change, and we certainly believe that going up the education level with us is going to help you. What I want you guys to do is, and understand is, we're sitting here in a class with, I don't know, 300 people or something. Whenever I go into a city, it's typically 200 to 300 people. We're all over the country doing this. The reason options trading has become, and will continue to be, a very interesting topic is because of the management of risk. And I'm trying to have you guys focus on that we sit up here and we can talk to you today, not because we don't wake up every day and say, how much money am I going to make? I mean, honestly, at some point, money is just irrelevant. Believe it or not. The whole point of life is try to get through life, enjoy it, have a good time, and all that stuff. But the bottom line is we're sitting up here because we manage our risk, and once you manage your risk, you can start learning how to make money. And that's what it comes down to, not sitting and saying, well, I'm going to buy a new Ferrari today on whatever I make. You don't want to do that. You want to say, I got money in an account, I want to keep it as long as I can, I want to learn this stuff, and as I learn it, I build myself up, and eventually, your life will look like a call option, okay? I'm going to draw your life as a trader. People say, I can't believe he can do this. Okay, this is a call option. What I need to do is get you from below the break-even line to at least the break-even line, and then I need to accelerate you up here, and what I don't want you to do is to expire worthless, okay? So really what it is go up the learning curve as fast as you can. This is my learning curve. Took me to go from where I was to break even 3 years, because I didn't know what I was doing. I didn't have anybody teaching me how to do this stuff. I didn't have any clue of what I was doing. I didn't know what a put was, a call was. I just figured I was smart enough to figure this out. And basically what we want to do, where you should be when we accelerate you out of here, is 7 years up my life, 14 years is here, and where I'll be 7 years from now, just visit me on my island, okay? Just come Optionetics Island or whatever we're going to call it. So, the bottom line is, what we want you to do is go up the learning curve as fast as possible, and we want you to accelerate it to whatever, how fast you want to go. I don't care. I can't legally sit here and tell you how much money you're going to make. I can just tell you based on the past, the people I know who follow our rules do real well. Nobody can prove this stuff doesn't work, because it all works. It's just a matter, if it doesn't work yet for you, you're not doing it right yet. The way I look at every class we do, if you pay us X dollars, you should walk out of there with 100 times the value. Meaning, if you pay me this kind of money, you better walk out of there being able to make 100 times that, at least more, at some point, okay? And because the bottom line is, for us, we understand that that's good money for a lot of you people, because I was there. I started with not a penny to my name when I first started to trade. In fact, when I started to trade, I actually had to borrow money from other people to trade, and which is eventually is actually how I started. And eventually I finally figured out what I was doing, and here I am today. So it's a great class. I only do, just so you know, there's only a few of them a year, because I can only do so many classes in a year. So it's a great class, October 9th, 10th, and 11th. If you can, when are you ready for this class? Honestly, if you sat here for 2 days and you listened to this, I have no problem you going right to that advanced class, because what happens is we put people who are experienced along with people who are not that experienced, and we want everybody to progress to a certain level by the third day. Maybe day one, everyone's not the same, but day 3, you're going to be amazed at the stuff that you can learn in that period of time. So I used to restrict people. I used to tell people 6 months of trading beforehand. Believe it or not, this is the way we first did it. 6 months of trading. I would then personally interview everybody to make sure they were ready. But we had enough people convince me to say, I'm just going to go, and I'm not going to hold you to anything. And then they become very successful thereafter. So I'm not worried about somebody going right into that. Yep.
Where do you think the person would be on that chart if they just took this class and not the advanced class?
Sure. No, I think obviously this class has tons of information for you guys. What I think the difference is between someone going from here to right to the advanced class, it depends how fast you want to go up that learning curve more so. I think that someone goes from this class to the advanced class, you're going to double your learning curve. Easily. So meaning this is tons of great information, but I think obviously if I can get you up the learning curve as fast as possible, then you know what? You don't have to worry about, of not knowing everything that even the most professional traders know. And once again, it's not like it's going to damage you not to make it out there. What we hope is that whether you make it to October or not, okay, what you guys are going to do, and because this is the way our company's been built over the 10 years, our company's been built on word of mouth, people being successful. So even if you walk out of here and deciding not to take that right now, you will at one point, I could tell you. As soon as you say, hey, these guys know what they're doing. I'm making good money. Let me take it to the next level. I have students who've been to every advanced class from 3 years ago that we ever did. They come to every single one. In fact, a lot of our advanced students come to these classes just to get more information. Yep.
I was just going to say, I've been to the advanced and super advanced with you guys. We have an incredible time. It's really a lot of fun. And I went right after the first time when I came to this class. The biggest advantage was sitting down with people that trade for a living.
Yeah, I think
we owe her money, George.
We owe her money. Yeah, you know what the difference is, really? Let me tell you guys. When you go to the advanced class, first, it's a lot of fun. You have a good time. It's like a wild party. Everyone's trading. They're having a good time. And it's much more relaxed. We get to make a lot of friendships, because we get to know people a lot better. I mean, that's part of the thing, is to have a good time, to sit down with people who do this for a living and to interact. We got some smart people, smart cookies, whether they're my instructors or students. We come up with a new idea here, a new idea, and we just interact together, which is what we like. And and we've had people who've gone through every single class we've ever done. We have people say, you need to develop another class, and we're like, we're out of classes to develop, guys, because really Tom and myself, we only have a certain number of days a year that we can work. We have to have some time off. And for us, teaching these 2-day classes is the hardest thing I do. Believe it or not, sitting here for 2 days and thinking through and doing all this is the hardest thing we do. We spend most of our time, unlike other people, too much thinking, yeah. Yeah, we spend most of our time when we're not, all of my time when I'm not here, is sitting in front of a computer looking for trades, doing trades, coming up with new ideas. We then take these new ideas to our advanced students. And if it works at our advanced student level, we then bring it down to the 2-day level. And we don't do anything until we've put our own money on the line, so you feel confident in that. Someday you'll come see us, there's no doubt about it, because we want every single student of ours to make it to the level where they want to be an advanced student, to where they come to our computer class. And the whole point of this company, which I'm fortunate enough has grown large enough that I don't have to spend any time on it, other than coming teaching a class. The whole point of the company is to get people as educated as possible, as fast as possible, and to destroy everybody else who's trying to do this. Okay? Because we have no doubt. I ran into somebody who does, another person who teaches options, and he came up to this funny story. Came to me one at a conference, says, you're my competitor. And I looked at him and said, I have no competitors. Really the reality is we trade lots of options. We know this stuff really, really, really well. And honestly, we're just trying to give you the best quality we can. So I'm going to leave this with Tom, because Tom's got to get into the calendar spreads. What's going to happen after Tom's done, I'm going to do collars, which is a sophisticated trade that we never used to teach at the 2-day course. And then I'm going to show you how to trade a collar with these new instruments coming out called single stock futures, all right, which is going to be phenomenal for you guys. I'm telling you, if you could do what I'm going to do at the end of the class here, you're going to be amazed at the potential of what you can do with no risk, okay? Anyways, let me leave this with Tom. And by the way, the market is down 226, 227. All right, I'm going for 300. That's what I said. Remember?
Yeah, I had this question, and I'm going to move on. You guys will be getting another. I've got another sheet that's going to come out a little later on here, and it's actually on calendar spreads. You'll have that in a few minutes. But I had a question about how many people are on our publications. We have a very limited amount of people that are on them, and the reason why is because if you get too many people looking at the same trade, chances are you're not going to get filled. And the other problem with that is that, for an example, we know, George and I both know a particular person that's a major publisher out there, and he's got about 25,000 subscribers on one particular publication. And not only does he publish what he's going to trade, but he publishes when he's going to trade. So imagine this. If you had access to a publication where there were 25,000 subscribers all going in on the same trade at the same exact time during the day, what would you do? You know what we do? We do the opposite. I mean, it's amazing. But I mean, we keep our limitation down to a few hundred. This is one of about 50 emails that I've gotten just in the last week, and I'm going to go ahead and show it to you because I was just on checking my email, and this one came up, and I'm deleting them as fast as I got them, other than saying thank you. This is a guy that says, he made over 164% in one day for Baxter, and went through a few other things here, and basically said that, I've made money on almost all the option finders trades that you've recommended. And it's a wonderful thing that we're putting out some good information that people are able to, invest in and get a return on your investment on. At the same time, the biggest thing that we do these for is to help you learn. We're not doing them out there for you so much to trade. In fact, what I tell people is if they're going to take a publication or something, learn what it is we're doing so that you don't have to take it again next year. It's really a instance of what we want you to do is learn how we're picking these trades, and we're just accenting more and more what we do in the seminar. Now, this calendar spread, and I'm going to talk about next, is a sideways market. It is a little bit more of a complicated trade. It is one of the least riskiest trades you can ever get into if you do it right. However, it involves using different months to expiration. That's why it's called a calendar spread, because you're using calendar months. Okay? There are a couple of different ways to take sideways positions in the market. Before I get into this, I'm going to spend just a moment talking about different type of sideways market strategies. If you want to look at the tape, the videotape that talks a little bit about this and goes through the finer points, you will be looking at tape number 6, which is sideways markets tape. But there are basically a few things you can look at. You can look at what's called a butterfly spread. Okay, a butterfly spread. How many of you have looked at tape 6 and reviewed that tape? Okay, what's a butterfly spread? Yeah, basically what you're doing is you're selling in the middle and you're buying protection on the wings, and you're attempting to capture money in the middle. But you know what it really is? It's nothing more than two credit spreads slammed together. It's a bear call spread and a bull put spread crammed together as one trade. That's the easy way of looking at it. And what you're doing is you're putting on a trade that here's the bull put part, and here's the bear call part. And then what you do is basically take away these parts, and you got a butterfly. Okay? How do you make money? As the market sits still, your profits rise up, and up here in the middle is where you make the maximum profit. Let's say we put that on with a stock that's priced at 50. You don't want the stock to go anywhere because this trade starts out like this, and as we get closer to expiration, the graph starts to form toward the black line where profits rise. Okay? Any type of sideways market strategy that we're doing has a graph that's similar to that. Another one would be called a condor spread. Okay? And a condor is basically the same thing, but it involves 4 strikes where you're trying to widen yourself out. And the reason I'm telling you to go to tape 6 is you can get the details on exactly what I'm talking about, but I wanted to make sure you knew butterflies, condors, calendars all make good delta neutral sideways market trades. Does a covered call make a good sideways trade? Yeah, unless the market goes down, then it doesn't look so good anymore. The problem with the covered call is it doesn't have a risk graph that looks like this that has limited risk. A covered call risk graph looks like this. Goodbye. This part looks good up here. We always feel calm at the top of the roller coaster, but when you start riding down the roller coaster, it's like, ah! And you don't know where the bottom is. And so unless you hit 0, then you know where the bottom is. Okay? Someone told me to pull a wave count up on WorldCom. I can't. Okay? When something's sitting at 14 cents, it's not, there's not, no chart in the world, nothing in the world could read where that thing's going. All right, so I wanted to make sure you're aware of that. But what we're going to look at is stocks that we expect to stay sideways. Now, does that mean we need to focus on stocks that just do this? No, that's one way of doing it, but what about something that's doing this? How many of you have seen a stock that does this, and all of a sudden then it opens down here? Okay, 5-minute success formula. You know what usually happens to these stocks for the next 30 days? While traders try to figure out where next it's going to go, the outlook could be sideways. These make excellent calendar spreads. So I'm going to go through a couple of examples with you, and I'm going to show you, I'm going to talk about what calendar spreads are, how to put them on, and we're going to talk about what makes a good calendar spread, and I'll show you some case studies too. And I want to show you some rolling case studies. I'm going to show you how we went from a month by month to roll from one we did in UAL. And then I'll take some questions afterwards. Calendar spreads. The big thing on calendar spreads is what we're looking to do is we're looking to sell a short-term option and buy a longer-term option. What this means is, well, short-term, how about 30 to 60 days? Okay, long-term, anything that's greater than 90 days. Makes a good long-term trade. And we're going to do it at the same strike price. That's what gives it that limited risk. Okay, that limited risk that's no more than the debit on the trade. And if you have your blueprint book, which ours now has coffee stains on it, thanks to George, you will be on page 19. Thank you. And so what I'm doing is I'm just simply talking about the strategy review right now. What is my objectives as a calendar spread trader? That's right. Milk the money out of the trade. Okay, milk the short-term premium out of the trade. We're going to buy the longer-term option and sell a shorter-term option for as little a debit as possible. Okay, I like debits at $2 or less. That's what I particularly feel comfortable with on calendar spreads. All right, that's objective number one. Objective number two is that we want to, like Pete said, capture more time decay in the option sold and we lose in the option bought. Because if a market stays sideways, if you own an option, you will lose time decay on that every day. All right, sometimes it'll be more than others, but notice that where do you lose time decay most? On a 30-day option or maybe a leap option? 30 days, because that's where the time starts to really hurt you if you buy an option. Well, if you sell a 30-day option and you buy a leap, guess what's going to happen? You're going to, because you sold that option, if the market moves sideways, you'll lose money on the leap, but you'll bring in more money on the 30-day option, and that's where this spread gains value. Number three, have the underlying stock move in a range over the time of the short option. That means what we're looking for is over the next 30 days or so, we want the stock to stay in a range that's right there where we sold the premium. Similar to the one I showed you where the stock had dropped heavily and then it moved sideways. We want our outlook to be sideways. And that doesn't mean that it had to move sideways the last 6 months. It's that we expect it to move sideways over the life of the trade we're putting on, the life of the short option. Does everybody remember this? Let me show you. I mentioned this yesterday. I'm going to show it again today. 90, 60, 30, 0. Okay, and we talked about that being time decay. Okay, and as we go through our time to expiration, imagine this. Well, if you were a buyer of a 30-day option, you wouldn't be feeling so good because if the market moves sideways, you could stand to lose that money. But if you're selling a 30-day option and you're buying a 90-day option, you might stand to lose that much on the 90-day option, but look what you have to gain on the 30-day. Okay, so here's your gain in premium, and here's your loss in premium. And what you're looking to do is take in more than you pay out, and that's how this spread gets bigger. That's the whole point on the objectives so I talked about. So, once again, we're going to buy the long-term option, sell the short-term option. Number two, we're going to capture more time decay in the one we bought than we lose in the option sold. Number three, we're using stocks expected to stay in a range. This is all on the entry rules on page 19. So you guys that are writing this down, you're wasting your time. It's right here. Look at me. Right there. Okay. Oh, entry rules again. Well, here's a couple of other things I want you to make sure you write down is that use at-the-money options whenever possible. And that's because at-the-money options have the most time value. Think about this. And we can look at, I could bring an option chart up from anything, and you're going to find the at-the-money options are always going to have more time value. The in-the-money is more expensive, but they have real value as well as time value. The most amount of time value you'll find on any option is going to be right at the money at the top, because that's where you find the most theta. If we looked at a theta curve, it's always highest at the money, because at-the-money options are the most expensive that have no value at all other than time. Pay as small as debit as possible, I talked about. Use stocks expected to stay in a range, I talked about. Each month, here's one, each month attempt to roll forward. Okay? What I mean by that is if I have a 30-day option and I have a 6-month option, at the end of the 30 days, well, I could just take the whole trade off, but here's a better idea. How about sell the next 30-day option? And after that, sell the next 30-day option and keep selling, selling, selling until you get to the point to where your sell and your buy are the same month, and then you're out of the trade. It's very much like a covered call. Who's done covered calls in this room before? Okay. Who's done covered calls and every month they keep redoing their covered call? They keep selling premium every month. That's exactly the same thing I'm talking about right here. The only difference is, guess what I got? I got a trade that has a lot lower risk than you have as a covered call trader. Because if you've got a covered call on, and maybe your stock's a $50 stock, you got $50 in risk. Especially if it was a WorldCom or .com or, something like that. What do I have for risk? The debit on the spread, which is usually for me 2 points or less. I'm going to give you a trade today that's a 50-cent debit. It's a real cheap calendar spread. And then last thing I got here is works well with George's 5-minute success formula. Okay? It really does, and I'll tell you, there's a guy that lives in Santa Clara, and he's not here today, Grant. And Grant called me a couple of years ago when we were talking about this then, and he said, I found one of the best ways to put calendar spreads on, and you guys don't even know it. Because we were using them for directional. We were doing just fine in directional, and he said, I found a way you can put calendar spreads on. He goes, heck, I've done a few of them for no risk. And I said, well, how are you doing that? He said, well, let me show you. And he showed us the 5-minute success formula. And he goes, there's one right now. And he goes, take a look at PSI net. So I did. And sure enough, I was able to actually do that one for a credit. Can you imagine buying a long-term option and selling a short-term option and getting 25 cents for it? Because that's what I did. I'll go through the rest of that story when I come along because it has a not a happy ending, but not a sad ending either. I'll let you know about that in a moment when we get the volatility skews. Remind me if I don't talk about it, because that's what that is. Risk and reward on a calendar spread. Okay, risk is limited to the purchase price. Okay, so your maximum risk, as it says here on page 19, is the debit. Risk goes down each month if you attempt to roll, and you can roll, meaning roll means you will buy back your short option at the end of 30 days and you sell the next 30-day option. And if you can do that at a credit, meaning that either you buy back or you let it expire worthless, as you bring in more time premium, what happens to the cost basis of your trade? It goes down. All right? Now, not every time, and I'll tell you this, I'm not a 100% calendar trader. My calendar spread trades have been about 80% of them have been winners. But then there's that 20% of the time where I'm going to pick something and it isn't going to go sideways anymore. Nothing's 100%. I might pick something and it moves up or it moves down. And we'll talk about what to do with those too when I get to exit strategies. But what I want to do is I want to be able to continually sell like a covered call trader each month. I want to sell that front month option. Okay? And I have unlimited reward on the long side. That's if I don't sell. Imagine now you've got a calendar spread which involves calls. That means you buy let me give you an example. We sell August because that's the next month coming up. Right now we're in August, correct? It's the front month option. And we buy January 03. Now, when August is over, I want to attempt to sell September options against my January 03s. All right? And then I want to sell October, and I want to sell November. If I decide not to sell those at all and my August expires worthless, what am I left with? I've still got a January 03 call out here, which has unlimited reward, and that's what I mean by unlimited reward on the long side. If you let the short option expire worthless, I know people that, and there's one of you sitting in here, that have done this with calls where you'll want a long-term call option and you'll sell short-term call options until you pay for the long-term call option, and then you're done and you got a free call. And there's people in the room that do this, and I know who you are. And that's fine. That's a great way of taking a calendar spread and basically buying a call and each month kind of renting out the short term till you're done, and you may have 6 months or a year left over. I think it's an excellent way of doing calls. Now, let me give you an example. XYZ trading at 30, trending sideways. Same strike price every month if you want to keep your risk basis the same. And I'm going to show that right now. Buy a January 03 30 put. Oh, by the way, is there any difference? Is there any problem with doing put calendar spreads versus call calendar spreads? Sometimes puts are cheaper, which makes it a better calendar spread. Let me tell you something else too. I had this happen to me one time. Once was all it took. I bought a call calendar spread one time, and I was short the front month and I was long the back. And I got assigned on the front month, which isn't a problem because usually all you got to do is just get out of the stock and sell the next month and you're fine. Only this particular stock had a dividend that was paid out the same time I got assigned. Now, if you get assigned short stock, guess what you get to do? You get to pay the dividend. Now, I didn't equate that into my calculation. Wait a second. That wasn't on my risk graph that I had to pay this dividend. So you know what Tom does? Tom does put calendar spreads. Because that way, if I'm going to get assigned, I'm getting assigned long stock, and I'm not going to have that problem happen to me. So that's why I do put calendar spreads, because of that and because they're also cheaper, which cheaper meaning that if it's a 30, if the stock's at 30, I look at the 30 put calendar spread and the 30 call calendar spread. A lot of times that 30 put calendar spread is going to be a little cheaper. All right, so it actually makes it a better risk to reward. So I'm buying a January 03 and I'm going to sell a July 30 put. And notice this example, I'm paying 3 for the January 03 and I'm going to sell the July for $1.50. Now, what's my trade going to cost me? It's going to cost me a total of $1.50 because I'm taking in that $1.50 on what I sold and I'm paying out the 3 on what I've bought. Is everybody with me so far? I'm just simply buying along. You know, the longer term option is going to cost you more. All right? The shorter term option you're taking in, you're going to get less in, but the difference is what you want to pay. That's your debit. I'm going to show you how to find really good ones that have quite a low debit, like the one I've got for you this afternoon. I'll show you exactly how we're finding those. What's my maximum risk? My maximum risk is what I paid. Let me tell you why. With puts, if the market goes higher, what happens to put options? Do they go higher or lower? Lower. Could this stock, XYZ, go to 100? Yep, if it did, what would the puts go to? Would both of them pretty much go to 0? Even though I got a longer term one? Yeah, pretty. I mean, if this thing goes screaming up, that $3 put's going to be worth about as much as the $1.50 one. All right, so here's the thing. If I paid $1.50 for this position, and now both of these are worth 0, what's my position worth? 0. Okay, how much did I lose? But did I lose any more than $1.50? No, that's the point you need to make here. Now let me give you a more realistic example using today's markets. Let's say this 30 put, or this stock, this 30 went down to 10. Or better yet, let's say it was a WorldCom and it went to 0. All right, now what do we got here? I've got a July 30 put, which has how many points of real value at 0? 30. How much is that January 2003 going to probably be worth? 30. Okay, plus 30, minus 30. What's my position worth? 0. But did I lose any more than $1.50? No. Okay, so realize that your value of your spread cannot go below 0. All right? Now, if in fact this does go down, what's probably going to happen to me on the short side? In fact, instead of what's imminent to happen to me on the short puts? Assignment. Okay, for those who don't know what assignment is, somebody who owns that long put can exercise their right to sell the stock, which means I have to be obligated to buy it at 30 if I have short puts. Well, here's the great thing about calendar spreads. If I'm obligated to buy that, don't I have something else that covers me? I've got that January put that I'm long, which means I can exercise my January, which allows me to sell the stock at 30. So if I've bought it at 30, I can then exercise to sell it at 30, so I'm out of the trade for no more than $1.50 loss. Okay, I want to make that perfectly clear.
If the July expires at expiration, aren't you in danger of being naked?
If the July expires at expiration, okay, calendar spread traders, I know there's a few of you in here. If that July option expires worthless at expiration, am I naked? No way, Jose, right? No way, San Jose. All right, here's what you got. You got a long put. You don't have a short put because if your July expires worthless, you got a January that you own. So you know what you have is a long option which you can then sell against. Now there was another hand up. Yes.
I'm not sure that that's what you want to do. If there's some time value left in your January.
If there's time value left in your January 2003 puts, sell them. You'll get more money. You'll actually get money back. But I'll tell you what, if that stock dropped to zero, I pretty much would have a good bet saying that there wouldn't be anything more than just real value in that. Now, if the and sometimes you're not. In fact, 95% of all options that are assigned to you happen the last week of expiration. So realize that. But can that stock be assigned to me on the last week of expiration if I'm at 20? If the stock's at 29? Yes. It doesn't have to go to zero to get assigned. It could be assigned a point lower. It could be assigned a dime lower. You know, and so to answer to kind of answer the question the gentleman said is that yes, that January 03 would have a lot of time value left in it if it's still up there close to 30. Now, when I get into exit strategies, I haven't even talked about entry strategies. I need to stay with entry. When I get into exit strategies, we'll talk about what we need to do to roll out of these. Okay? Is there any other questions on this example? You're getting into exit strategies. Let me get into exit strategy. I think I can answer your question. Any more questions on this example? What is the date on the July? July 2002. Okay, and then and this example was one I took last month. So if you want to take one as of today, we could call it August. Yes, sir.
I'm a total novice. How do you know when you get assigned? Does your broker notify you?
Yes. Your broker will notify you the next morning after an assignment. If he doesn't, get another broker. You'll get notified by email. That's, obviously the course of action. If you're assigned, by the way, if you're assigned on expiration day, which would be Friday, you may not get assigned until Saturday, so you maybe wouldn't receive an email until Monday morning. So just realize that too. Yes?
In this kind of market where there's a likelihood that everything's going to kind of go down, do you have any criteria for whether you would leave the long option?
No, what I do is what's really pretty much going sideways? A lot of these techie NASDAQ stocks that aren't going down much anymore. What's going down is safety stocks. If you guys looked at stuff like Sun Micro, Broadcom's been trading at the same price for the last 6 months. Look at stocks that you think are going to go sideways over the period of the long you want your short options. This is not a Microsoft trade. This isn't an IBM trade. This is trades on stocks that were big down last year that are moving sideways, and it just so happens they got a high implied volatility because of what's being affected around it. So if I was that bearish on something, I'd just simply buy puts or put vertical spreads. Now, what I'm showing you here on this graph is if we bought the January and sold the July, and then each month we attempted to roll forward, selling August, maybe we get a little bit more, selling September, maybe we get less, sell October, sell November, sell December. What am I doing? I'm adding money to the, and I didn't have any time, maybe 1 month I didn't have any time value to sell, so it just didn't make sense selling. But what I'm doing is I'm lowering the cost basis of the trade. Now, if I put this trade on for $1.50, by the time August rolled around and I was able to sell for $2, what did I do? I'm now into a credit. And as you continue to sell more time, you can actually bring in this case, 8 points of credit. What's my January 03 put? It could be worth still $1. Okay? So you're looking at an original debit of $1.50. And a total credit of $7.50. You look at this for 1 month and you're like, yeah, it looks all right. You throw a few more months on here and all of a sudden you've got a risk of $1.50 where you can make several times the risk. But it's different than straddles. It's different than directional trades because it takes time. This is those of you that sell cover calls know exactly what I'm talking about. It takes time to bring that money in. Okay, it's a 30-day trade at least because where do you make most of your money? Cover call people. Where do you make most of your money on that cover call? In the first week of the 30 days or the last week of the 30 days? Yeah, so this is something you got to be sitting into. We're not getting into this to get out of it tomorrow or next week. We're getting into it to stay into it through the final week of expiration, and when I get to that, then I'm going to talk about exit strategies. Here's a risk graph of a calendar spread. By the way, and I'm going to show you this, you can put risk graphs on our website, either what we call the classic version or the modern version. Have you shown them that, George? This is the classic version. Okay, it shows a risk graph going up, and if you notice, prices on the bottom, okay, and profit and losses on the side. This is the modern version, where we flipped it over. Some people like to view it this way because you can take a look at it and you can say, well, wow, as long as my stock stays in between here and here, I'm at least at break even. And if it's right around here where we are at the end of expiration, I could come all the way out to this point. Okay, so that's what the modern version looks like, and I think somebody put a nice little such and such on there for me. All right, Pac-Man. It's like that's what basically a calendar spread is to me. I mean, you're just eating up, you're eating up time. Only it's coming into you instead of going out. Now, here's a case study using United Airlines. All right, United Airlines, like several other airlines, were sitting still. This is a 5-minute success formula case, and I think all of us in the room can look at stocks and determine whether they're going sideways, looking at charts in the past and getting an idea where they're likely to go. Where we find really good calendar spreads is on something called a skew. And I'm going to talk about what a skew is momentarily, but this is a stock that dropped over 40% in one day. It hit the 5-minute success formula, and you can see what happened in the course of the day. Volatility jumped. If you look at the chart here, volatility went from being low to being extremely high. If you look here, we've got 4 different colors of volatility. The red line represents the 30-day options. The blue line is the 60, green is 90-day, and black is greater than 90-day options. Isn't this interesting that the red line is higher than the black line? And if I'm going to sell 30-day options, I'm actually going to get more premium than normal in this case. And if I'm buying the 90-day or greater options, I'm going to be getting a better value. And what I'm doing is the options I'm selling are high in premium. The options I'm buying are lower in premium. Okay, that's called a volatility skew. I want to talk a little bit more about what that is when I get to those slides. So that's something that we looked at when putting this on. There's a 37% difference between the front and the back month. This shows that short-term options are expensive, and it shows that the longer-term options are cheaper, not in price, but in premium to expiration.
This completes CD number 13. Let's review some of the most important points covered on this CD. A butterfly spread is a limited risk and limited reward strategy that involves buying one lower option at support and one higher strike at resistance, as well as the sale of 2 at-the-money strikes with the same expiration. Butterfly spreads use all calls or all puts and usually create a net debit, which is the maximum risk of the trade. The maximum reward is limited to the difference in strikes minus the net debit. To calculate the upside break-even, subtract the net debit from the highest strike. To calculate the downside break-even, add the net debit to the lowest strike. A condor spread is similar to a butterfly spread, except it uses 4 strikes and therefore has a wider spread and a wider range of profit. A long condor is composed of all calls or all puts with the same expiration. To create a long condor, buy a lower strike option at the support level, sell one higher strike option, sell an even higher strike option, and then buy one even higher option at the resistance level. The maximum risk is limited to the net debit of the options. The maximum reward is limited to the difference in strike prices minus the net debit. The profit range exists between the upside and the downside break-even. The upside break-even is calculated by subtracting the net debit from the highest strike price. The downside break-even is calculated by subtracting the net debit from the lowest strike price. A calendar spread, also called a time or horizontal spread, is composed of selling a short-term option and simultaneously buying a long-term option using either all calls or puts. A short-term option has 30 to 60 days until expiration, while a longer-term option has 90 days or more until it expires. The maximum risk of a calendar spread is limited to the net debit of the two options. The idea behind a calendar spread is to capture more time decay in the option sold than is lost on the option bought. Always try to pay as little a debit as possible. Profit occurs when the underlying market continues to trade in a range until the short-term option expires. If the underlying market moves the short option into the money and it is assigned, you can always exercise the longer-term option to hedge the assignment. If the short-term option does expire worthless, it enables you to keep the full credit, and then you can always roll forward by selling another short-term out-of-the-money option against the longer-term option. In fact, you can continue to sell short-term options against the long-term option until the expiration month of the long-term option. This concludes CD number 13 of the Optionetics course audio series. When you're ready, please insert CD number 14. CD number 14. Tracking the Sideways Market Continued. Welcome to CD number 14 of the Optionetics course audio series. Now, let's return to Tom Gentile and his informational lecture about calendar spreads.
Here's September 17th, UAL, down 43%. By the way, when September 17th was the first day the markets opened up after September 11th, what George and myself and the other guys were doing is we went back and looked at some sentiment indicators. We were looking at the amount of puts that were being bought on these airline stocks versus calls the weeks prior, and it was quite amazing. In fact, they were coming up on our lists of extreme amount of puts being bought, and I overlooked them. I mean, I looked at them and just kept moving on. And I think it was because I was more interested in the Labor Day, the Labor Day selling, getting all my positions set up. I completely overlooked the fact that what was going on. And then we looked back and went, wow, somebody knew something. There were a lot of puts being traded on these airlines and insurance companies before this happened. But when we did open up, you know what went down. Airline stocks, Royal Caribbean took a bath. It was like the Titanic. When that stock, I mean, just woof, down to 8. But this had a 43% drop that day and made a great calendar spread. What we did was bought the January 15 puts and sold the October 01. Now notice, how much time do we have between those two? The October was the front month, okay? It had 30 days to expiration. What's the January have to expiration? In fact, January 03 ain't even here yet. Yeah, 15 months to expiration. Now look how much we got for the 15s. We got 75 cents. We paid $2.25 for the 03s. Pretty cool, huh? That's what volatility skew does for you. It makes you buy things and sell things that are a little bit abnormal from where they normally should be. All right? That 75-cent option should not have been a 75-cent option. It was $2.50 out of the money. We couldn't find a 17.5 to sell, or we would have done that. But the 15 was there, so we went ahead and sold the 15. We brought in some decent money there. Cost of the trade, $1.50. Now imagine this. 1 month, 75 cents. 15 months, $2.25. What's $2.25 divided by 15? Cheap, right? Okay, that's the fastest answer I could give you. Cheap. All right? Like 15 cents a month, right? Okay. What's my maximum risk? $1.50. Here's the trade as it's keyed into our website. Buying the Jan 03 15 puts at $2.25, selling the October 15 puts at 75 cents. Look at the spread on this thing that day. 35 to $1.05, and we got 75 cents. I'm telling you, there are certain days when you do not want to be trading market orders. Okay? This was one of those days. Market orders just were not something to do. But these are the prices that we got. So, $1.50 debit. Here's the trade. Now, this risk graph, when I'm looking at it, doesn't look that exciting. And I'll tell you why. Because the way I'm looking at it, my risk is $150, but I'm only going to take in a maximum of maybe $125. All right? What am I missing here? Yeah, that's only for 1 month. I'm forgetting about the other 14 months. So, At each expiration, I basically have two options. So what I'm doing is we got the trade on. 30 days pass by. Now I'm out of October time premium. I've got two options. First thing I could do is I could just close out the current month, which would be what? October. Now how do I close out something I sold? I buy it back. And then what I can do, I can sell or open the next month. Or I could just close the position. And to close the position is just reverse the trade. Buy to close the current month and sell to close the long month. All right? Of the two options, what I do is I look at them and say to myself, are we going to continue to possibly move sideways, or do I need to just close this position out? All right? Most of the time I like to roll forward because I can cut my risk down. Everybody got that? Yes.
When you put the order in to roll forward, do you put that in as a net debit or net credit?
Yeah, good question. The question was, if I put this in, can I put, I think what you're saying is, can I put it in as all as one ticket?
Right.
Yes, absolutely. Good question. Do you guys understand what he just said? Putting it in as one ticket means that, you've got your long option already out there and you've sold your short and your short's going to expiration. What you can do is you can buy that short back and sell the next month as one trade. And you can do that for a net credit. That's what you want to do it for, is a net credit. Yes, sir.
Also, if you're going to roll it, you probably should do it on like Tuesday or Wednesday. Because if you do it on expiration Friday, lots of times the expiring one doesn't give you enough premium to roll over the next one.
Yeah, let me comment on that too. Probably the best thing, and most of my rolling happens on Wednesday. I have let one go all the way to Friday, and I'll tell you what, that was the Ryder. Remember Ryder truck I was talking about with you guys yesterday, and I told you I was the only person in this trade? Here, let me tell you what happened. This was a calendar spread. I did a Ryder truck calendar spread. It was a 5-month spread between what I sold and what I bought. It was 2 weeks to expiration on the front month, but something was going on with Ryder truck that made the options expensive. So I sold the ones that were expiring in 2 weeks, and I bought 5 months out. And the trade had doubled in value in 2 weeks. And I thought, all right, I'll just close this whole thing out. Double my money. I put on like 20 contracts. So I go to get out of these things. I waited until Friday. In fact, I waited until 10 minutes before the market closed. All right, I'm looking at the open. No, I didn't even look at the open interest. I called Mike Lotch. Any of you guys know who Mike Lotch is? One of the guys that's one of our traders. And I said, Mike, can you see, look at the bid and offer on this trade? And he says, so I gave him the rider. The October 17.5 was what I had. And we were looking at 17.5 puts. And the bid was 0, and the offer was 50 cents. And I sold these things for $1, okay? So they wanted 10 minutes to the close. By the way, these were out of the money, all right? They were to the point where they were either going to expire worthless or the market was going to tick up and they were going to expire in the money. It was that close. So 50 cents, I'm saying, these guys want 50-cent credit with 10 minutes to expiration. I said, why is that? And he goes, how many contracts do you have? And I said, 20. He goes, you looked at the open interest lately? And I said, no. He said, well, it's 20. And that's what I want. So I'll plant you with this question. You tell me the answer. If you're dealing with a stock that moves about 10 cents a day, up and the range is just so little, it's just amazing. Would you risk going into the weekend and possibly getting assigned, or would you rather buy back the option for your 50 cents? How many of you would say, A, I'm going to risk going into the weekend, and if I get assigned, I'll get out of it on Monday, and if I don't get assigned, that's fine? How many of you would do that? All right. How many of you would say, I'm just going to buy it back for 50 cents and close the trade out? Okay? Now, I did the first, which was I said to myself, I am not paying these guys 50% of what I took in 2 weeks ago for only 10 minutes. In fact, by the time I got done jabbing on the phone with Mike, it was down to 2 minutes to expiration. And it was still 50 cents. Well, it wound up expiring worthless, so it was fine. So next Monday morning, what did I do? I went ahead and closed the position out, and I was fine. Now, if this thing moved around a couple of dollars a day, I would have got out. I mean, what's more risky? Getting out for 50 cents or risking the fact that this thing could open $2 against me the next day and now I'm down $1.50? That's the way you want to look at calendar spreads, especially, and you know what, to avoid all that, just deal in stuff that there's more open interest in there than you. All right, and you'll be fine. Here's let me continue on. UAL. UAL is is now at 1477. So here's what's happened. The stock has dropped from 1750 down to 1477. I'm at the October expiration now. So what am I doing? Now I'm going to read these off to you here. I bought a Jan 15 put for $2.25. I sold an October put for 75 cents. Look what I did. I bought back my October put, and then I rolled forward and sold in November. So I bought back for 28 cents, and I rolled forward for $1.35. Okay? That's how you got to put it into the website, is that when you want to make an adjustment, you just simply roll forward. So what did I do? I closed my position out by doing what? Buying back what I sold, and then I opened up a new position by selling the next month out. All right, now what has happened to my position? It started out as a debit of $1.50. What do I have now? I take $1.07 off of what? My $1.50. What's my new cost basis now? 43 cents. Does everybody see that? Okay, now my debit, 43 cents. Moving on. Now if you look at the trade, you'll see that the debit now, or the maximum risk, has changed. It's now down to $43 per contract. Here is the risk graph. Does that look a little bit better than last month's risk graph? I should say so. Okay? So what I'm doing is I'm going to show you a couple more months on this one, but I'm going to show you how it turned out. And look at the graph. You see the big drop? How it went from up here in the 40s, boom, down, down real low. And now we're sitting at 14, and in fact, this day was 1477. And so we're going to move forward. We're going to look at it another month. I'll take 2 questions, and I got to move on.
Do you get, with advanced get, do you get confirming indicators with a side range?
You know what? The only thing I find with advanced get that works well on calendars is if you get the red circles, the ABCs. If you get continually ABCs, it's telling you there's no trend, and that's a good calendar spread.
It's not possible to run a calendar spread with the other short months added in. Originally, we got to just do one short month at a time.
No, I'm running it with all the other short months in. I'm just buying them all back. That's the software. The way the software is designed is you could buy it back for 0. Okay, if you let it expire worthless, then you want to key it in as buying it back for 0. It's just like any accounting where if you sell something, you eventually got to, in order to have it say expire worthless, you just put a 0, you 0 buy it back, and then it will X that out and move on to the next month. All right, November expiration. Here we go. What have we done? Well, we own the Januaries. We sold November. Okay, we're going to sell December, but in order to sell December, what do we need to do? We need to buy back November. So, but look at this one. This one expired worthless. Goodbye. So we'll buy that back for 0. Open up a November position. How much did we sell November for? 75 cents. What's that going to do to my debit now? Hey, look here. Net credit is 75 cents. Now, check this out. I'm going to back up a second, and I'm going to go forward. My risk, see my maximum risk? It says minus 43. Now, watch what happens when we add in the next month, in November. Look at the maximum risk now. It says plus 32. That means that's a 32. The worst that can happen is I keep $32 in my pocket. Look at the risk over reward now, 1,197%. That's nice. I have a credit now of 32 cents. It's the worst I can do. Let's look at the risk graph. Look at the risk graph, guys. It tells everything. This is 0, and this is profit, and here's you on the worst case. Here's you at the best case. Okay? Again, for those of you on the other side of the room, this is your 0 line right here that runs up and down. Here's the worst place we could be in the world, and that's the $32 profit worst. Here's your best case scenario now. And what is happening with this graph? It continually goes farther and farther and farther over to the profit side, because what are we doing to make it go over there? We're rolling forward. December, UAL is at $13. We're selling puts. We're buying back our 15s, and we're selling our January 02s. And I can just continue to go through this here. We've closed this position out. We're going to open a new position. We've got a net credit of 85 cents now because we took in $2.08. We paid out $1.95. What is that doing to our position? Now our credit's 117. Now our cost basis is at 1.17. And the same thing again. Now look at the risk graph. You know, I'll move through a little faster here. January. You know how long it took me to put this thing together? A lot longer it took me to do this trade. I'll tell you that. Okay? $212. So now the 2.12 for that month. Okay? It's moving on out there. February. Anybody want to guess when I actually closed this trade? Am I still open? Okay, 242. Now look at that risk graph. That's getting funky now. Okay, so I mean, you want to, you know, this is the beginnings of taking a regular strategy and putting some adjustments to it and thinking outside the bun. You know, like they have on that commercial. Think outside. Think Taco Bell has the think outside the bun commercial. Think outside the box, and the box would be where everybody else is trading. Here's us. Here's everybody else. You know, and this is an example of just simply going through, making some adjustments, reducing my cost basis every month, increasing my profit every month. Okay? By the way, trade's out. Trade was out in March. $592 profit. 395% return on investment. Okay? And that was in all of it in the process of where did we start? We started at what month? October. October, November, December, January, February, March. 6-month trade. What did it originally cost me? $1.50. See? It's like watching grass grow. You know, you put a few of these on. And by the way, those of you who talked to me during the break and asked me, is there any use in probability in options trading? Because we have probability models on our Platinum site. This is the best strategy to use with probability. Because it really is, I mean, what you're expecting is you're expecting the market to stay in that range, okay? So by putting together a trade such as this and adjusting it every month, all you're doing is increasing your probability of being what? Right. Now let me give you some exit rules again, because what I did was I basically took you through a trade and I showed you rolling it every month, all right? So exit rules are basically this. Each month when you're in the trade, I'm holding until expiration week, that short month. If I wind up being in the money, and what I mean is if I'm in the money by a strike or two, then I will roll forward. What does roll forward mean? It means, that's right, it means buy back a short month and sell the next month out. And you want to do that for a credit. If you do it for even money, you're just spending commissions. I've done it for even money a couple of times because I was expecting the market to move back, which several times it did. But you want to try to do these for a credit because it's going to reduce your cost basis. If it's out of the money, let's say that you put the trade on and it runs away from you. Guess what's going to happen to your short position? It's going to be worthless. Let it expire worthless. That means you don't have to pay what? Yeah, it's the last time I remember. I don't remember my broker charging me to let something expire worthless. Right, Robert? Let the current month expire. Sell the next month on the day after expiration. The reason I say that is, can you sell, let's say this, it's Friday, and you got a calendar spread, and it's just slightly out of the money, and you know it's going to expire worthless. It's 10 minutes to the close. Can you go ahead and sell next month's? How many of you can do it? How many of you can't do it? How many of you just don't know? All right, well, here's what, if you have naked writing option ability, you sure can. You can do it. But most people, what you're going to do is you're going to wait till Monday morning, and then you sell it on Monday morning. Okay? You want to sell it the next day, on the next day after expiration, or that following Monday. And, you know, I don't have it on here, but what if you're at the money? At the money is the best place you could possibly be, and it's also the worst place you could possibly be. Because that's where the most profit's going to be captured, correct? Okay. It's the worst place you could possibly be. Why? Because, well, you know what? Because it's the highest maintenance thing you got to deal with. Is it going to be in the money or out of the money? In the money or out of the money? In the money or out of the money? I mean, it's almost like that's the worst week of trading for a calendar spread trader. And I say worst because it actually takes a little. You have to be there. You have to be watching your positions constantly. Okay, so the third week in a month, if you're a calendar spread trader, you know, does anybody in here get 12 weeks of vacation per year from their company? If you do, yeah, I do too. Uh-oh, not anymore. The thing is this, is that, you know, if you're going to take a vacation as a trader, the best time to take a vacation away from work is going to be the third week of the month if you're a calendar spread trader. Of course, if you don't work, then that's the only week. Then you'll be able to take how many weeks of vacation? 36 weeks, because you only have to work 12 weeks a year, and that's the week that we expire. Because that's the part you really need to watch your position. But what you would do is you would basically, if it's going to be at the money, more than likely you're going to have to roll it right there around the expiration week. You could let it expire and then roll the next day, but that means you've got to watch it right into Friday. Probably the best thing to do is just simply buy it back for the nickel or whatever it's going to cost you, and then sell the next month out for the 75 cents or $1 or $1.50 or whatever you're going to get for it. On the final month, if you happen to take your calendar spread, which is, let's say I decided I was going to take my October to January 03, all the way to January 03. Well, what happens when December's over and I'm now looking to sell at January 03? What am I selling? I'm selling what I own, so the trade is closed. And that's what I have here. Just sell the position, or you can convert the long side, which basically means sell off the long side. Now, how can we find volatility skews? Excellent question, George. We can do calendar searches on the Platinum site. In fact, this is the Platinum site. There are three things that, because we can look at the amount of hit rates that are on our website. There are three things on our website that most people go to do. Create trades so they can look at the risk graphs. The other thing they like to do is do searches for quiet stocks and things for straddles and look at rank lists. The third thing that people like to do is go in and actually perform a search. And I'm going to show you the search that we teach at the computer training seminar. I'm going to show it to you right now. What you see here is part of the calendar spread as we search for it, but I'm actually going to go into the website and do one for you right now. What I'm looking at is, I'm going to back up here and go to Optionetics.com. Okay, here we are. And what I'm going to do is I'm going to come down here and I'm going to click on Create a New Search. So I'm going to create a new search. I made this as big as I possibly can, so it looks a little goofy, but that's because the text size is so large so everybody can see. And what I've got here is I'm going to select the OEX 100, because I know all the stocks in the OEX and the S&P 100 are liquid. So that's good. The next thing I'm going to do is I'm going to come down here and I'm going to click on calendar spreads as the two criteria I want to search for. Buy an at-the-money call spread, buy an at-the-money put spread. And I now have those in my selected strategy box. The only other thing to do is start adding criteria. Now, what was the criteria we talked about for calendar spreads? Let's see if I can remember. I'm going to write these down, and then we're just going to plug them in, because I want to show you just how easy it is. There were three criteria for calendar spreads. The first thing I talked about was, what are we selling? 30-day options. And then we were going to buy greater than 90-day options. Okay, that's important when we set up calendar spreads, that we're going to be able to put these in somewhat similar to this. The second thing is, what was my cost? 2 points or better. And then what was the skew? Implied volatility skew we want to put in there. I did not say this, but I'll tell you right now, I like a skew of 15% or greater. That's it. I think that's it. That's all I need to deal with right now. So we're going to flip over. I'm going to put all these into the calculations. So first thing, let's go to cost, risk, and option quote filters. Trade cost should be less than 200. So I'm going to put in 200. Let's move down to expiration filters. Days to expiration must be greater than. You know what? I want to have it at least greater than 7, and I'll tell you why. You don't want a calendar spread where you're selling the front month with 2 days to expiration, because there'll always be an implied volatility skew in that. So make sure it has at least greater than 7. Now, minimum days between calendar spreads. Remember how I like to buy that? I like to sell the 30 and buy like the 90. So I'm going to put 45 days in here. So that's going to spread this out where I'm not buying the month right after the one I'm selling, because I need to have at least 1 month in there to make an adjustment. What was the last thing we talked about? Implied volatility. Well, we've got a lot of implied volatility filters here, but the one I'm interested in is, and I'll explain these to you. These are, let's see. This is programmer language. I'll give you George and Tom language, okay? The first one says the latest at-the-money IV must be in the historical high range. This means anything that's high vol. The next one is low volatility. The third one says near month must be higher than far month. Hey, Does that sound familiar? Near month IV must be higher than far month. What do you think I'm going to put in that little box right there? 15. So I'm going to change this to 15 and turn it on. Now, I've gone ahead and clicked on search, and it's going to go through and it's going to search for calendar spreads. While it's doing that, I'm going to move on. This is what a search will look like, okay? And what I did was I went ahead and X'd out a search from a recent one in July, and this brought up a few trades. It had a Bristol-Myers trade in it, and it was buying a January 04 and selling a January 03. Is there any problem buying a leap and selling a leap? Yes? No, not at all, especially when your volatility skew looks like that. Okay, so I mean, there's several ways you can go in and create counter spreads. You can manipulate them a little bit. What we wound up doing was going with the August over December 02 because the skew here, that red line represented August. The black line represented anything that was greater than October. So we went with the widest skew we had, and we looked at, okay, let's buy the August and sell the December 02, and look what the debit was, $100. Now, an interesting thing I want you to clue in on is right there. Check that out, 41% volatility skew. Where do you think skews are found better in? Low volatility or high? High. You know, there's an abundance of calendar spreads right now. Calendar spreads are like a feast, and straddles are like a famine. How do I get 41%? Anybody here in the retail business? No? Okay, well, I'll explain retail to you. Retail minus cost over, you take the difference of the two, you apply it to cost. Okay? That's how you get 41%. Take the 45% minus 64%, what do you get? You get about 20, you get 19, you get like close to 20. Take that 20 and put it over 45. There's your 41% skew. Anything over 15 looks good. The biggest I've ever seen is 70. That was in Ryder Truck. It was. It was great. You know, with certain stocks, I find this works better on losers than winners. I won't try to chase something that's going up because you never know where it's going to go after that. But if something goes from, say, $50 to $25 in one day, chances are it's going to stay in that mid-20 range for a while. And what happens if it stays in the mid-20 range? What happens to the skew? As we stay and stay and stay, yeah, that skew starts to collapse, and is that good or bad for you? It's good after you get in the trade. Okay, here's the Bristol-Myers Squibb calendar. Let's see if I got any results on this. Still searching. Finding the best calendar spreads. I'm going to go ahead and finish up here on calendar spreads. Implied volatility skews are the most important criteria for calendar spreads. Okay, obviously non-trending stocks are the best, but you can apply this to the 5-minute success formula. Now I'm going to talk about the trade I did in PSINet. So Grant calls me and says, take a look at PSINet. I take a look at it, and I said, wow, are these prices right? And he says, yeah, I just did 80 contracts at a quarter credit. And all right, I'll check it out. And he says, here, don't trade more than 20 contracts at a time. And I said, why? He goes, if you trade more than 20 contracts at a time, you're going to tip somebody off on the floor, and that price is going to change. And I said, all right. So I did 20, got filled with a quarter credit. So, wow, this is great. Did another 20, got filled with a quarter credit. Did another 20, did another 20. I had 80 contracts. Grant calls me back. He goes, hey, you got 80 contracts too. I said, yeah, I'm fixing to get another 20. And I went in for that last 20. Well, sometime between what all the contracts he was doing and all the contracts I was doing, somebody looked at the boards. And I threw my last 20 in there, and I actually did them at the market. This is why I say don't do them at the market. Because then I got filled at $1 debit on my last one. So imagine this. A quarter, a quarter, a quarter, a quarter, and then $1 debit equals what? Yeah, so talk about a sweet deal gone bad. And what happened with the calendar spread? It actually wound up being worthless. But had I stayed with the original 80, I would have been able to pocket that quarter. Instead, I walked away at break even, which wasn't a bad lesson. But the thing is that in times of adversity, when markets are moving around crazy like that, you will find sometimes where trades look too good to be true. And a lot of times they will be too good to be true, but then there's going to be some which actually you can get off at a credit as long as you stay under 20 contracts, because That particular threshold is where somebody handles it with a piece of, they handle it by hand, and they take a look at it, and then they tell their buddy, and then they do it for a credit, and then just before they change the prices back to break even. How many of you found trades before that you just thought were unbelievable in the room, and then you put them in, and then you never got filled? Okay. I used to do that all the time, where I'd find something, I'd call down on the floor, I'd place the trade, and they'd say, no, you know what, you can't do it. And one time I placed, and I heard the guy say, no, you can't do it. And then he muffled the phone, but he didn't put his hand over it good enough. He goes, hey, did we get filled on that thing that this turkey told us about? Great. And I went, what did you just say? So I knew that there was stuff out there you could find. The thing is that what I didn't know was that, a lot of times you're telling the floor trader something that they're not seeing, and you're tipping them off on something. By putting these in, and by the way, I did this one on the computer. That's why I was able to get, bypass the floor trader even knowing about it. Analyze the calls and puts for the lowest cost. Most of the time you'll find puts have a lower cost than calls. Have an exit plan for the short side each expiration. Now, I have a real-time trade for you today. Goodyear Tire. This is taken from our calendar finder as of today. We're going to put this trade in for the week. All right, Goodyear Tire has a skew. Let's look at Goodyear Tire. Let me see what Goodyear Tire looks like. This is our calendar finder. Okay, here's Goodyear Tire. There's the chart. Here's the volatility is nice and high. Let me see if I can tell you what the skew is. The skew is, okay, the buy side is going to be 62, the sell side is 80, so that's going to be 18 over 62 is probably, it's better than 15%. The trade is as follows. We're going to buy the October 15 puts, and we're going to sell the August 15 puts for a debit of 50 cents, opening both sides. This is probably one of the cheapest trades we've given out in the last 2 days. Someone asked me, can you find trades for $50? Well, there's one right there. $50 trade. Okay? Costs $50 to get into. What are we looking to possibly do with this one? Well, sell August, sell September, and then get out of October. Okay? What can we possibly get out of this trade? I think 2.5 to 3 points isn't out of the question. Okay? Because the skew is obviously there. So you can definitely make more than your risk on the trade. If you guys are thinking about calendar spreads as a one way of making money, this is a good one to start with because it's really cheap. Okay, I mean, I do them at $2 or less, but every once in a while we can find some of them that are real cheap. I think the lowest one we ever put out as a trade to students was 10 cents. This is the one we found. Yeah.
What will happen if you use a different strike price?
What will happen if I use a different strike price? Are you meaning if I sell a different strike price than the one I own?
Yep.
Okay. What will happen is this. You will have additional risk in the trade, and additional risk will be the difference between strikes. Let's say that next month I decide I'm going to sell the 10 instead of the 15. Okay, now what do I have in it? The cost of the trade plus an additional 5 points, because if Goodyear goes away from the trade, then you've got 5 points of risk, which is the difference between strikes. You want to keep the strikes together to create a delta-neutral calendar spread. You want to keep your strikes together as best you can. Now, if all of a sudden you think this is no longer a sideways market and you want to be bullish or bearish, then that's a possibility. Yeah?
So after we place this trade, do we have to do any monitoring at all? Or just leave it like this?
After you place the trade, do you have to put any money into it? What? Oh, monitoring. Yeah, your monitoring is that you want to look at it during the 3rd week of August. That's what we do. Okay? Hey, you're not allowed to ask questions. You've been here too many times. Go ahead.
If you were to sell a lower strike put, like let's say for example, strike 10, the additional risk is not 5 points. You're actually protected by 5 points, isn't it?
No, actually what would happen is in order for you to sell the 10, you probably would be selling the 10 if it went down to 10, correct? Now you're selling it, you're trying to convert it into a bearish position. Well, what if it goes back up to 15? Now what happens to your 10 strike? It expires worthless, but you know what? Think about this. How much premium are you going to lose in that 15 put that you're long that's now got 5 points of real value in it? If it moves back up, those 5 points are going to click off fast, and that goes against you.
Is there a risk of buying the far out month with too much volatility, even though you have a good volatility scheme between the shorts?
Is there a risk of buying a far out option with too much volatility? The only risk of buying a far out month is you might wind up paying more than 2 points for the spread. For example, someone asked me at the last seminar I was at in Dallas, why don't I just buy the January 05s and sell the Augusts? I said, well, you could do that, but you won't find one for 2 points. It might cost you 5. But now look what you have. You have 2.5 years to expiration on one side and 30 days on. There's nothing wrong with it. You just got to realize it's going to cost a little bit more. That's the only risk that I see you have. Okay?
As a new subscriber, will you provide the coaching if I want to use this strategy as a cash flow strategy month after month?
Yeah, let me tell you what we do with this. Is each week we put a trade out. On the 3rd week of expiration, we send out an additional sheet which shows all the trades that we have open and what we intend on doing with each trade. That comes out every week. It's because this is really, of all the publications that we do and all the strategies we do, this is the toughest one to do because it's very hard to stick something out there when you don't have a clear exit strategy, and your exit strategy is what? The last week of expiration. So what we do is we'll put something out that says Goodyear. Okay, Goodyear is in the money. If it stays in the money, we're looking to roll forward by buying back our August and selling September. Or we might have something that says if Bristol-Myers Squibb is out of the money. Okay, if it stays out of money, we're expecting to let this one expire worthless, and then Monday we're going to go in and sell the September 15 put. So yes, we add an additional page once a month on there because we're waiting until that final week. So on the second weekend, because the 3rd weekend of the month is too late, but on the second weekend of the month, we send these out on Saturdays. You get an additional page which shows everything that we do. Yeah. All right. Let me finish up here with this. One more question. Sure.
On the first example you had for XYZ, July and January, you get assigned in July. Do you have to wait till January to?
No. If you get assigned in July, in fact, if I get assigned in July, what I'm doing is let's say I get assigned long stock. I'm immediately going to buy back I'm going to sell my long position, and I'm going to go ahead and sell the August puts. That's exactly what I do. Every month, if I happen to get assigned, I'm automatically rolling into the next month. And you can do that as quick as the time you get assigned. Okay? Interesting market close we got here. I'll let George tell you all about it.
All right. We're going to have a new product to sell in the back. It's a new Optionetics T-shirt. Anyways, I know I'm losing my mind, but that's what happens on the second day. Anyways, okay, here's the basically the market close. And first let me say, your hours are really messed up out here. So that's the first thing I'm going to say. So I remember one time I was trading out, I think it was in Las Vegas, and it was 4 o'clock, it was like 3:58 Las Vegas time, and I called the floor to say, put this order in, and they're like, we've been closed for 3 hours, by the way, So anyways, you can see the market actually just had a little bit of a tumble again. We didn't hit my minus 300, but right now you can see the markets are actually trading. The S&P futures continue to trade, and they're actually trading up just a little bit. And in fact, some stocks keep trading too. Just so you know, even when the market's closed, you can come home from work and you can still watch that little ticker symbol at the bottom of CNBC, and they're still trading. They're trading stocks all over the world, and they're doing it through computers. So you got to realize that you can do this 24 hours a day if you really want to do this. I mean, when I first started doing this, I'd be neurotic about trading, and I was actually trading currencies. So currencies trade 24 hours a day all over the world. And you'd wake up at 2 in the morning, and you're like, you'd be passing by that computer, and you just didn't, you had to like, I have to see it, I have to see it. And if something's exciting, you sit there and you watch it. So try not to be too neurotic. It's not good for your health. That's the first thing. You can see Sun actually is trading. Whenever you see that blue line change, that means there's a trade happening right now at whatever that price is. So there's still trading going on. Sun is actually, you can see, closed at 406, but is trading at 401 to 402 right now. You just look at the bids and the offers. The bids and the offers are telling me what they think is going to happen. So Intel, is that trading higher or lower right now from the close? Just a little bit. I mean, the last will give you the last price on the close, and the bids and the offer is going to tell you what's happening. So you can pretty much watch this all day long if you want. I mean, if I want to watch Microsoft, Right now, Microsoft, is it trading higher or lower? Pretty much even, just a little bit lower. And this goes on and on and on. And people actually, there's what's called their aftermarket trading, where in essence there's computers now that trade. And you can, basically put on trades after hours. Many people don't do it on the after hours market. Let me, just before I give it back to Tom, one crazy thing happened to me. It was just funny. While Tom was speaking about calendar spreads, I had just done a call calendar spread. You can put calendar spreads and call calendar spreads. And something just happened to me that I have not seen in a long time. And you guys, I want you to see if you can understand this with me. Okay. No, I didn't get skewed there. But in essence, last month I had, and I want you to think this through. This is a real case study. I had sold, okay, the Intel $20 calls, okay, for July. And I bought the Intel $20 calls for August. Now, as Tom mentioned, you can do either calls or puts. Okay, what I figured what was going to happen here, what I wanted to do is I knew Intel, I didn't feel Intel would break above 20 by July expiration, so I wanted to have those expire worthless and keep the ones for August because I figured it could rebound in August. And my cost was really low because the volatility was really high. I think I did the spread for like a quarter, 25 cents. All right? So what happened was we went to expiration. I did quite a few of these. And I just got an email while Tom was speaking, which was kind of funny. It said, you've been assigned on 15 of the calls that you sold. Now, Intel closed at $19. This is a true story. It just happened. First time I've ever seen this. Now, which means that the calls should have expired worthless, correct? Isn't that what happens? If basically the call should expire worthless. So now they're saying to me, George, you now are forced to do what? Sell? What is when you sold the call? What have you done? Now I need to sell Intel to somebody at $20. Okay, and the stock's at 19. Is that a good idea? I'll do that all day long. I do not understand this, guys. It happened to me. I mean, let's put it, I swear to you. And I'm sitting there and I was just laughing because I'm like, well, he only did 15. I wish he would have done a few more of those things. I do not understand. That happened to me.
That actually happened to me too. And the only thing I can come up with as to what happened is some novice on the other end wanted to see what it felt like to exercise an option. That's the best I can come up with.
Well, you know what? I could have given him some more pleasure with some other things, but that was stupid. What he did was stupid, actually. What he made me do is sell him a stock at $20 when it's trading at $19. And I'll do that all day long. I wish he would have done the number that I had on. Then I would have been really, really happy. But no, it's just like I just laughed because it was a small, it's a small order or whatever. And I was just sitting there, and it's only happened to me once before. And the only thing you can do is think of why would someone do that other than trying to. Yeah, I mean, I don't understand. I mean, it doesn't make any sense. So if you get exercised when something you sold is out of the money, that's a good thing, by the way. So, and now with Intel trading at 18.30, I'm more than happy to sell them at 20. And you know what? If he wants me to sell them more, I'll be happy to do so. Okay. All right, I'm going to leave this. It's just a true story. And, it's the first time ever I'm sitting here and I get an email from my broker that you've been assigned on 15. I thought that was just kind of funny. Yeah, question?
Yeah, can that happen due to a time delay in terms of when you put the order in?
No, the Intel closed below $20. No, that's been on for a month. I mean, Intel closed below 20. If it was at 21, I understand. I'll sell it to him at 20. He could sell it at 21. But now I'm going to sell it to him 20. He's got it at $19 on the close. It does. Honestly, I don't understand, but I just had to tell you that it's a true story. It's a laugh. I've been assigned on 15 of these contracts. Just so you know, Intel closed at the very end down at 1826. So it started to sell off just like everything else. And what I want you to understand, there's a lot of, there's a big volatility skew in all these. I mean, even if you looked at Intel right now, I'm going to show you a real example here. Let's look at Intel. If you were to sell an August 17.5 put, you would get how much? $1 for it. Okay? If you went to September and you bought a September 17.5 put, you'd pay $1.55. So how much would that calendar spread cost you? 50 cents. Can you see that? There's a lot of examples of these things out there that basically Intel can still go down to 17.5, and based on volatility, this 1 month difference is 50 cents. The next thing you want to do is you say, well, if that's only 50 cents, go to October and maybe work your way out to see where you can get maybe a little bit of a debit that's reasonable. There you've got $1.90. So now you can buy $1.90, sell $1.05, let's say. So there's still 85 cents there. Which one would be better to do? The October, buy October's, sell August, or buy September, sell August? Probably October's, yeah, because the premium, as you start to, and this is the way I test my calendar spreads, is I just go a little further out until I find, the one that I feel comfortable with. And like, Tom said, keeping them at $1 to $2 is a reasonable area to keep these things. If you do make it to our Vegas seminar, I promise, what we do is we show you different versions of calendar spreads. We have things called split strike calendar spreads, split ratio calendar spreads. We have all sorts of calendar spreads. I mean, we spent an entire day on them because what you just saw was the most basic version. But there's so many different things you can do with that you'd be impressed. And that's why we say most of our trading is calendar spreads, because we can be really, really creative. Phil Wigan, who's one of our instructors, bright guy, 25 years old. And he and his dad took our course. And he went to the 2-day course, and he and his dad took our advanced course. He's 25 years old, and he knows almost as much as I do. And I am so impressed on how smart he is. He does 95% calendar spreads.
He's probably the Optionetics most eligible bachelor too.
Yeah. It's just amazing. And I told him, look, I'm 42. In 17 years, I expect you to take care of me because I'm teaching you all this stuff.
That's right.
But I mean, bright kid, and he loves this stuff. I mean, he just sits there creating new risk curves, and we have him teach calendar spreads because he loves calendar spreads. And I would say
the only place we can get Phil to is an advanced seminar now, because he's that much of a trading machine. Let me show you guys. I got 3 more things I want to show you. Just there. You can look at that, guys, and I'll take the question. Why would you want to exercise out of the money?
Let me go back to what that whole issue was. You personally can exercise an out of the money option, but it's stupid. Okay, right. Because what happens is there's no value. Yes. Oh yeah. Let's put it this way: you can buy You can do it. You can buy an out of the money call with the stock at 20. Buy the 100 call, okay, and exercise your right to buy the stock at 100 with the stock at 20. Go for it, baby. But you know what? Before you do it, call me, and I'll take the other side. Yeah, I'll give him a little discount too.
I have the results of what we did was I punched in that calendar spread. It took about 2 minutes to run this. And what it did was it looked at 1,142 trades. It took the best 97. The top 97 met the grade. Xerox. Now, I didn't have a stock price limitation in here, but I could put it in if I want to. But you could do the Xerox October-August for $50. You could do EP, 15 call, January over October, $50. And what we basically did is it will rank them any way you want. Rank them by probability. I had it rank them by cost. I said, show me the lowest cost first, and then I'm going to go down the line. That was the first thing I wanted to show you because I didn't get a chance to go back and show you that. If you want to see how we've been doing, George and I, on our calendar trade results, this is a listing of our open positions just for this year. Last year we had over a 200% gain. We're up at about 97% as of June in this particular example. Okay, I've got 19 after 2. We're going to go ahead and take our final break here. When we get back, we're going to get into collar spreads, how to protect your portfolio, and then that part I talked about, which is what you need to be doing first, second, and third when you walk out of here.
Calendar spreads are designed to take advantage of theta decay and volatility skew. To find a promising trade, look for a sideways moving market and then investigate its implied volatility of its options. Look for short-term options with a higher implied volatility than the longer-term options. Occasionally, this enables traders to find calendar spreads that can be placed at a net credit. The maximum profit and break-evens must be calculated using option software like the Optionetics.com Platinum site. Let's review calendar spread exit strategies. 1. Hold on to the short-term option until expiration week. If you wind up being in the money, you'll need to buy back the short month and sell the next month out at a credit or at even. 2. If the short-term option is out of the money, simply let it expire and keep the entire credit. To roll forward, sell the next month option on the day after expiration. How can you find volatility skews? Do a calendar search using the Optionetics.com Platinum site. Simply click on Create a New Search, select the market or markets, and then click on Calendar Spread in the selected strategy box. Then add the following criteria. 1. Search for options to sell with 30 days to expiration and options to buy with at least 90 days or more till expiration. 2. Choose the point spread or cost for the overall trade you are seeking. And 3. Decide what volatility skew percentage you are looking for. Tom Gentile's preference is a skew of at least 15%. You can also create calendar spreads with a bullish or bearish bias. Different versions of calendar spreads are addressed at the Advanced Optionetics seminar. This concludes CD number 14 of the Optionetics course audio series. When you're ready, please insert CD number 15. CD number 15, Protecting Your Portfolio with Collars. Welcome to CD number 15 of the Optionetics course audio series. In the final session of the Optionetics seminar, George Fontanils and Tom Gentile discuss a fairly sophisticated strategy known as the collar.
All right, what I'm going to do during this session, just so you know, what I'm about to teach you, we used to never, until about a year ago, we never used to teach at our 2-day course. We figured it was too sophisticated or whatever. But now we decided about a year ago to bring it to the 2-day course because we think, especially when the markets, and we started teaching this when the markets were a lot higher, and some of our students came to us and said, thank you for teaching us collars, because that's what I'm going to do now. I'm going to teach you a fairly sophisticated strategy, but I know a few of you guys have your circuit breakers on off, but just write down the notes, listen carefully, and you can go back and do some studying. I know it's a ton of information we've already given you today. Okay, this strategy is called collars. Pretty much this is if you happen to win the lottery and you go to a big investment bank and you tell them to not lose you any money, this is what they would do in the stock market. A collar is a very sophisticated approach to trading, but it's really not that difficult once you finally see what I'm trying to do. In essence, all you're going to do is, it's basically 3 legs. A trade's going to have 3 legs to it. First, there's going to be an asset. Okay? For most of you people, that's going to be the stock. So if you have stock right now, collars could be something to do. Okay? If you don't have stock, don't buy stock. You know, I think that's, I think you got the point at this point. Now what we're going to do is we're going to buy an insurance policy. What did we tell you that insurance policies were? Calls or puts? Puts. We're going to buy a put long term at the money, roughly right where the stock is. Okay? And then what we're going to do is we're going to come above and we are going to sell an out of the money call. So basically it's 3 legs: own stock, buy put, sell call. For those of you who have done covered calls, raise your hand if you've done a covered call. A covered call basically to me is not a safe strategy unless you find stocks that go only up or sideways. And as you can tell, that's not an easy thing to do these days. And so what this really is a covered call with a protective put, is the way to look at it. So in essence, what you've done is created this thing called the collar. Now here's the important thing. You know, it's going to happen pretty soon. There's a new product out there coming pretty soon called single stock futures. And I'm going to explain why that's important, because when you put a collar using single stock futures, you're going to be able to create potentially really good returns with no risk when you do it right, which is a really cool thing, by the way. And in fact, what I'm teaching you here is a basic collar. In Las Vegas, we have 4 different versions of collars. But this is, once again, it's not a basic strategy. Many people don't even understand this stuff. All right, so single stock futures, for those of you who don't know what they are yet, all it is going to be a way to control stock for less money. It's going to be a futures contract on a stock. So for example, if you have whatever, Intel trading at not $20 like I just sold it to somebody for, but Intel trading at $19, let's say. What a single stock future is going to let you do, instead of putting half the price of the stock, remember, right now you'd have to put up how much? Half the price of the stock, 50% based on margin, you'd put up what, $950, which means that you're using 2-to-1 leverage. What a single stock future is going to allow you to do is put up 20% of the cost of the stock. So that's, they're still playing with the rules and this and that, but it's going to be roughly 20%. What's 20% of 19? $3.80. So now you can control Intel for $3.80. Does that sound like a good thing? Sure it does. If maybe it isn't a good thing, if you didn't protect yourself, but what you've done is you protected yourself. What it's going to do, it's going to allow you to basically control an asset for less money and basically then protect the asset and then pay for the protection, which is really what we're doing. It's kind of like you insuring your car. I have a car, I got to get the insurance, and I got to pay for the insurance. Well, you know what? The insurance that you have to pay for is going to come out of your pocket, we're going to take it out of the market to pay for the insurance. Now, let me just show you why single stock futures are important. When we put all the numbers together, you're going to see why it's much better than buying a stock. Remember, because the whole point of everything we've done in 2 days is to try to control an asset for less money, as little money as possible. Okay? Where you can get more information, just so you know, on single stock futures is go to www.onechicago. I'm sorry, it's not optionetics.com. What that is some exchanges, the major exchanges in Chicago got together and created a new exchange called One Chicago, which is going to be basically the main exchange for single stock futures. And you can go to the single stock futures. You can go, in fact, I'll go to that website and kind of show you here. www.onechicago.com. What you're going to get is basically their primary website. And within here somewhere, they keep changing this for me, you can go through here and you can learn a lot about single stock futures, etc. And you can get a list of all the stocks that are going to have single stock futures. They're going to be Intels and Ciscos and Oracles and eBays and people like that. I don't know if WorldCom will have any, but in essence, what you want, you go through there and try to learn as much as you can. What it really is just telling you, we're going to create a futures markets on stocks, individual stocks, not the S&P 500, not the NASDAQ, but on a stock like Intel, let's say. And the reason, once again, that I'm going to use single stock futures to put a collar on it is you're going to see how the numbers work. It's really going to be a phenomenal potential return once these things come out. In fact, what happened, these things were actually out over 20 years ago. Hard to believe that the government had these. We had these out over 20 years ago. Now, basically what happens is you've got 2 regulatory bodies out there. One is the SEC, which handles stocks, and you have another regulatory body called the CFTC, which handles commodities or futures. 20 years ago, they could not decide who was going to regulate these things because it was kind of a hybrid between futures and stocks. So the government said, if you can't figure out who's going to do it, then we're just not going to have them. I'm telling you, this happened 20 years ago. Now, about a year or so, roughly a year or 2 years ago, what happened was in London, they started to trade these things. So the United States traders do not like to lose business to anybody overseas. And what happened is they started trading them in London, they started trading them in Canada. The U.S. people didn't want the business to be going over, so there was actually Congress got involved in the year 2000 and said, we're going to create a new act that says both the SEC and the CFTC have to regulate these together, and we don't care how you do it, you're going to do it. And so what happened was there was a new, I think it was called the Commodities Modernization Act of 2000. This act came out that says we're going to allow single stock futures. They were supposed to be out before September 11th, well, around September 11th, but you know what September 11th did? Put everything on the back burners, and now I hear that around Labor Day is when they're supposed to come out. Okay, they keep postponing them, and don't hold me to that, but you know, we're hoping by Labor Day they come out. Now, what's going to happen is when these things come out, I'm going to do a three-pronged trade. I'm going to buy these single stock futures, as you can see. That's going to be my asset. I'm going to buy an at-the-money put option, which is going to be long-term, and then I'm going to try to find some calls and try to sell those calls for whatever the cost of my insurance policy is. So if I pay $4 for an insurance policy, how much am I going to try to sell a call for? $4. If you can do that, you have a no-risk trade. Because what you're doing is, you have an asset at, say, $20, or whatever the price is. I now buy an insurance policy that allows me to sell it to somebody at $20. Do you guys get that so far? But you pay, say, $4 for that insurance policy. How much would be the risk on just that? If I have an asset, I buy the policy to sell it to somebody at the same price, but I pay $4 for that policy. $4. The risk would be $4 because you have the right to sell it to somebody at 20, but remember break-even points? We bought the right to sell it to somebody, but we paid $4. So if I then sell an option, a call option for $4, what would be the risk? 0. That would basically what it's doing is my insurance policy costs $4, I sell something else for $4, that gives me an obligation to sell them the stock at a higher price, and I've actually got a zero risk trade. In fact, this is what the risk curve will look like. Here's the risk curve on a covered call. Tom did this one earlier. A covered call, just so you know, looks exactly like a naked put option. So if you've done covered calls, you have done synthetic naked puts, which you know what my feelings are on naked puts. The only problem is over the years, the brokers have sold covered calls as a safe way to play the market. And that's a bunch of you know what. You know, it's just not true. So what it really is this is a covered call. Now we're going to buy an insurance policy. What does that do to my risk curve? Knocks it off. So now what I've done is I have eliminated all this risk. Now it looks like a no-risk bull call spread, basically is what it's looking like. So what it is what you've done is an intelligent way to do covered calls, but instead of buying a stock, you're going to sell, you're going to buy a single stock future. Now the thing is, why was it important to know about the SEC and the CFTC? The reason was because right now, if you trade futures, you have to have what kind of account? A futures account. If you trade stocks, you have to have a stock account. Now, if you try to use a hedge, if you buy something in this account, you can't hedge it with something in that account. Okay? Meaning when the computers do a calculation, you don't have a good hedge. However, what the SEC allowed and the CFTC, the rules are that if you have futures accounts, you can do single stock futures, and if you have stock accounts, you can do single stock futures. So now you won't have to open a new account. Now whatever you put on as a hedge in this account will work as a hedge, okay? Which is a wonderful thing, by the way. So I know this is sophisticated, but you know I'm trying to take you guys to a new level here because this is going to be a great way to trade. So what it's saying to me is that you can have a stock account at wherever your stock account is, and once they get up and running with single stock futures, you should be able to trade single stock futures in that account, buy stock options, buy options to protect yourself, and sell options against the position. Okay? Now a futures contract has a limited life. So let's say these things come out, whatever, in August, and I buy a December Intel future. If I happen to take this to the expiration date of that future, what happens to me the next day? You're going to do just like an option. This is going to have to, whoever has this future at the very end is going to take delivery of 100 shares of stock. So if you happen to put this in your account and you don't basically want this, or you have to do what? If you got to sell it. Remember, whatever you buy, you sell. Whatever you sell, you buy to get out of it. So everything offsets to get out of whatever you got to get out of. Okay? So what would I do going into expiration? Well, I would sell my December futures and say buy the March futures. Just keep it away from, as it gets to expiration, these are not going to have, these are not, basically going to have the time value like you do in an option, and no one's going to force you to exercise them. So what you need to do is just take it to the expiration and then move it away. Now you have an asset at a lower cost. Okay, so all I'm going to do is keep these futures in place. I can keep my put option in place, and then I'm going to sell the call against it. So once again, it's a three-step process. Futures, puts, calls. Okay, that's what I'm going to do. All right, so how do you make money on these things? You're going to make your money between, in fact, let me just go ahead and do it. If I bought a stock at 19 and I buy the put at 20 and I sell a call at 30. Okay, let's say that's what it came out to. Where you make your money is between these 2 points. Basically where the stock is and where the call you sold is. Okay? You've created what's called a collar because you now have an obligation to deliver the stock to somebody at what price? $30. So you can only have it appreciate from this price to that price. That price would be 30. That difference between those two prices will be your maximum return. Okay, that's your maximum return. So here you would make $10, let's say, in that price. So basically this collar right here, because remember, if the stock's at 19 and you bought the $20 put, it's going to lose $1 worth of intrinsic value. So you got to start at where the put is, going up to where the call is. So here's a $10 max return. If you put up the stock, if you did this with stock, let's compare the two. If you did it with stock, how much would you have to put up to do this trade? You would have to put up half the price of the stock. Is how much? Say let's make it $10, make my life easy. Okay, just make the calculations easy. You buy a put option. Say you buy the put options for 4, you would have to have another debit of 4, but then you sell this call option at 4, you have a credit of 4. So how much is your cost? $10. So if you can make $10 on $10, what kind of return do you have? 100% return. Okay. So if you can make 10 on 10, you have 100% return. Okay. Now let's turn this into a single stock future instead. We said that instead of having to put up half the price, let's just put the stock at 20, make my life easy. If I had to put up 20% of 20, how much would I have to put up? $4. So now you can make $10 on a $4 investment. You see what the difference is? Because the cost of the put's going to stay the same, the cost of the call is going to stay the same, but now you've reduced your cost by 250%. So what's going to happen here? What's your return now? 250%. It's taken up the returns 2.5 times. So if you find a collar with a 50% return, you can make 125%. So basically a collar at 40% that you can put with stock is going to become 100%. So you find one that makes 50%, it's going to be 125%. You find one at 100%, you make 250%. So what it's doing is it's making a very large potential return risk-free if you do it right. Now let me ask you, how many of you would be happy with 100% return risk-free every single year? Okay, very good. So would I. But you can even get it higher when these things come out because it's just a matter of finding the stocks where this is going to work. And it's typically going to be the higher volatility stocks. Okay, when volatility is high, these things are going to be tremendous. Okay, and obviously we're that kind of market right now. So, once again, it's a 3-step process. Asset, puts, calls. Asset, puts, calls. Asset, puts, calls. It may be the only thing I ever do. It's maybe the only thing you ever have to do once these come out. That's why we're dying for them to come out. Yeah.
George, one question. What is your basic cost going to be for that future?
The future is going to be 20%. Right now, the regulators, I believe, are agreeing at 20% of the cost of the asset. So 20% of whatever the cost is. Yeah, there won't be interest costs. The futures don't have interest carrying charges. So, no, it won't be like borrowing stock where you borrow. If you use margin, you buy a stock, it's at 20, you go to $10, you only put $10, they're going to charge you interest for the other $10 you borrowed. They won't have that on futures.
We'll just have to pay transaction costs.
Transaction costs, that's correct. Yes, you will have a commission, whatever that might be. Way in the back. Okay, I had some people in the back first. Yeah, go ahead. Yes.
If the underlying asset takes a nosedive,
Yes.
would there be a margin call?
Okay, here, that's a good question. If the underlying asset falls, was there a possibility they'll call you up and say have to put up more margin? Yes, there is, because that's the way futures are. Yeah, even though you have a hedge, so if someone, one day you wake up and the market has fallen apart against you and they say margin call, what happens? What do? Just get out of the trade. You take your profits off the other stuff, it all evens out and you have zero cost. So, I mean, that's really what happens, and I'm going to show you that this is a trade that makes money on the upside. If it breaks down, I'm going to show you how to make money and change it around so you trade this. This is a very tradable position. It's not like put it on and just wait forever type thing. Yeah, question back. No, the question is, why would the value of the calls be higher than the value of the puts or be at the same level? The reason is because the way options are priced are based on where the options can go. Okay, so if you look at a put option at 20, how far can the stock go to zero? So it's going to create the options pricing models are going to create a price blank. How far up can a call go? Infinity. So the options will typically on the call side will have a greater cost than on the put side. So that's what happens. It's the way that the markets price these options, but it happens more so in the high volatility. Low volatility, the collar, the price between the 2 points gets too narrow. Okay, in a high volatility it expands. For example, when the internet stocks were going crazy, I am telling you that it was amazing the collars that you could put on. I mean, it was just incredible that you could put on collars that were so wide because the volatility skews were so wide. I mean, it was just incredible the difference between two. Now you have to work a little harder at it. I mean, you really do. But high volatility typically is going to give you the best situation for it. Yeah. Yeah, the question is if you're going to go like do the S&P futures, whatever, the only problem with the way the S&P futures are trading is they typically don't give the calls that upward looking sky, so to speak. But you can look at it. It's possible you can do it, okay? So it's a little harder. What we're going to do is we're going to take a futures contract. We're going to combine it with an equity contract. We're going to then sell another equity contract against it. And let me tell you, no one's ever done this before. I mean, this is a brand new thing. So there are going to be a lot of price discrepancies. There's going to be a lot of people doing mispricing on these things. And it actually gives you a lot of opportunity. You'd be amazed. You'd be amazed that, you think with all the computers, prices are always the same. They're not. One exchange could have a different price than the other exchange. I remember doing a trade once where, they caught it before I did it, where I was going to be able to buy it from one exchange, sell it to the other exchange as a simultaneous trade, and make $1 on my trade. And because of the pricing, it was just off. And, once in a while, I'm just amazed that that can occur. But it does occur, yeah.
Will you be able to get long and short positions on these futures?
The futures will allow you to go long the position or short the position. And let me continue a little more because that looks like one heck of a mess up there on the thing. All right, let me just synthesize this a little more. We are going to have an asset. Right now, your assets could be stock. You can do a deep in the money call right now, which will give you a kind of like a futures type look, or you can do a single stock futures. I'm going to take these single stock futures. I'm going to buy at the money long-term puts for X, and I'm going to then try to sell my out of the money long-term call for X. X being equal. X should equal to X. However, I do get this question, and even in our advanced class, which is, a fair question. Can I just do short-term calls against my position? Yes, you can, but you're not going to be able to get X for it. For example, if I sell this put, which just goes to the year 05, or buy the put that goes to 05, and I pay, whatever, $6 for it. But now I sell a call option, and I only get $2 for it. How much is your risk at that point? $4. So you can do it, and maybe over 3 to 4 months you've paid for that put option, but you got to realize that it's not a no-risk trade going into the trade. Nothing wrong with doing that. I mean, there's nothing wrong with doing that. You just got to realize it takes a little more management because you now have to do this month after month after month. So it's really not that hard of a concept. And I'm the first one to tell you here, guys, that we have yet to do it ourselves because they don't exist. All right? So it's a matter of we'll make adjustments to this strategy as soon as they come on, and we look at the pricing, and we do this, and we talk to the brokers, and we look at the computers, we figure out all the margins, and when we put into place. So after you've seen these things come out from One Chicago, then come visit us again at another seminar in the future. And by that time, hopefully they'll be out, and we'll have enough information that we can get a little more creative with you. Yep.
Profit will be considered a futures profit or equity profit?
The question is, will it be a futures profit or an equity profit? I suspect the futures will be a futures profit, and the equity side will be an equity profit. And I know you're saying that for tax reasons. You just get, different. You get different allocations, so to speak, on how they're treated. So, I don't know. And if you're asking me something about how the IRS will interpret something, I don't know. I was a really bad CPA, so it's. You don't want to ask me any tax issues. I really was. Yeah. Yeah, well, that's the thing I was just mentioning. If you put them at the same expiration month and X does equal X, then you will have a no-risk trade. If you can change the expiration months, but remember that if you sell this call for less, say this is 6 and this is 4, you're going to have $2 worth of risk. You can change it and it changes the profile, okay? And let me tell you once again that for those of you here who, this is going to be a phenomenal way to trade the stock market. Because, you wake up one day and the market's getting killed, you just have to say, so what? One of the best things that, some of our students did, I remember they came to me and said, thank you, thanks for starting to teach callers, because I had one guy who I know had a big portfolio, and he showed it to me, before he put all these collars on, they were all in internet stocks. The internet stocks fell apart. He came to me and said, I didn't lose a penny. Well, everybody else's, certainly fell apart. So it's a great way to trade. But I'm going to show you how to trade these because it's not just putting them on. All right. So really remember, it's only 3 steps: asset, insurance, sell options against it.
George,
yes.
By selling the short, making your call more short term, you're going to be selling a better premium.
Yeah.
Because you'll do it more often, so you'll catch up with that
Right.
$3.
That's exactly. The point of if you want to do short term, you're going to be better in the theta decay curve.
Yeah.
Okay? The theta decay curve's on your side. So if you buy a longer term put, buy an asset, sell shorter term, you just have to realize when you first put it on, it's not a perfect collar, but maybe in 3 months I pay for the cost of the put anyways. So it really depends on how much you're going to work at it. Yeah, I agree with you. This is exactly it. So it really depends how much you're going to work at it, and I'm going to show you what I mean by that in just a second. So once again, all I'm going to do, I'm telling you what it's good, because this is all theoretical because they're not out yet. When these things first come out, I'm going to buy the single stock futures, look for puts that cost X, sell calls against it that cost X, and then I'm going to manage my trade. Now, which stocks am I going to do? Well, they're only going to be in about, I think, 50 stocks initially, so I've got 50 stocks to play with. And within those, I play with the ones I typically play with anyways, Intels and Microsofts and Ciscos and Oracles. And you can find the list in there. I believe they're going to have some broad-based indices also. And broad-based means like the OEX and things. I haven't looked at the list in a while, but it's going to be one of those things that if the product catches on, it's going to be a huge product. And I know a lot of institutions are already looking into this, how they're going to use it. I was asked to be a speaker at a single stock futures conference by, JP Morgan. I don't know if I'm going to do it or not. Tom just wrote an article on this stuff for the Wall Street Journal. And so this is big. It's a big product. And, you guys will be the first to understand how to use them because most people first can't even figure out options in the first place. So what we're going to do is take you to a new level. And I'm going to tell you how collars by themselves are not used by a lot of people. We had the head of trading at Fidelity Investments sit through this 2-day course. I didn't know that. Really nice guy, one of the nicest guys you'll ever meet. He was taking notes in the back of a New Jersey class, I remember. Some guy said, you wouldn't believe who's sitting in your course. It was the head of trading at Fidelity Investments, taking notes faster than any of you were taking them. And eventually he became a good friend of mine. And, he took our very first advanced class, and we showed a collar, and he's like, that has got to be the coolest thing I've ever seen. And he's been trading for 20 years. And, trading, I think on a daily basis, he mentioned they were trading about 8% of the New York Stock Exchange volume. And he didn't even understand collars yet. I went to another money management firm up in New York, I remember, and I was doing a presentation for them, and I had to run off to a trade. They said, what are you going to do? I said, I'm going to go do a no-risk trade. And they're like, there's no such thing. And I said, give me 5 minutes and a computer, and I'll show you. And these people basically were managing billions of dollars. And for example, anybody who started or founded an internet firm and kept their money, how do you think they kept their money? By collaring their stock. I can tell you, there's a lot of examples. The guys who kept their money, and I'm not going to name them by names, but I mean the guys who kept their money after they founded an internet company is because they collared their stock. And what means they bought puts against it, sold some calls against it, and now they can't lose, which is really, one of the reasons I want to show it to you. Let me show you something important here. This is very important. Okay, you're going to have your asset. You're going to have your put. And then you're going to have your call. Say it's at 50. Whatever. The asset's at 50. I picked eBay. I picked somebody who can move a lot. What you are really doing here is you are creating, we call this the waterline. You want to be above the waterline to make money. If you're below the waterline, you're sinking. Okay, which doesn't mean you're losing money, it just means you're not making money. Okay, so keep that in mind. So if the stock now moves down, boom, I wake up one day, hey, what the heck, I bought this, let me change the colors here. I bought this, black. I buy this put, sell this call. I wake up one day, the stock's at 35. Man, got killed. You have not lost money. However, what happens at this point is your waterline has changed. Where's your waterline now? Well, believe it or not, it's still at 50, but you need to make it at 35. You need to change your waterline. The reason is because, let's say the stock goes to 35. When did I say you start to make money? You got to be above the waterline. So now you have to have the stock go from 35 back to 50 before you can start making money. That's not a good thing, by the way. So what should I do? I need to change my waterline. How did you create your waterline in the first place? You have an asset. Well, you still have that asset. It's just lower priced. You're going to have another put here, and you're going to have another call here. So what do you do with the ones you have above here? You sell. Whatever you bought, you sell. Whatever you sell, you buy. Now you buy a new put here. You sell another call there. See what I'm saying? It's just recreating the trade. You don't have to do anything with the stock. The stock stays in place. The stock stays where it is, or the single stock future stays where it is. It's basically what you're doing is moving the calls and the puts. You're going to move them up and down, creating a waterline. The stock goes down to 20. What do? You do the same thing. You create a new waterline. Whatever you sold, you buy. Whatever you buy, you sell. The same option, same expiration. You create a new waterline. Buy puts, sell the 30 calls. Whatever the numbers are. So what you're doing is you're moving this waterline down, so hopefully the thing will finally shoot up at some point and you can make your money. Do you see what I'm doing there? I mean, I want you to understand that. I know it's more sophisticated, but remember, all you've done is created a position that basically says you want to be above this. So if it goes below this position, you need to make an adjustment. You need to bring this position down. Yeah.
How far would you let the stock move?
Yeah, that's a good question. How far would you let the stock move? I typically would say a 20 to 25% move is probably worth the commissions to change it. We're going to talk about the up now because the stocks do go up. And if you're right, you want to change the waterline again. Let me do the upside first, okay? Because the upside it's the exact same thing. Let's say you put on a stock 50, you buy a put, sell the call. Say I sold the 65 call. I've got my water line here. You're a happy camper. The stock went to 65. Now you want to change your water line. Why would you want to change it? You've already at your maximum point of reward. The reason is because stocks go up and stocks go down, right? So if you don't change it, you're going to give up any profits if the stocks go down again. So let's say the stock went to 65. Yay, stock went to 50, boo. You went to 65, yay, went to 50, boo. You've not locked anything in. You have not done anything to lock in your profits. So what you want to do is move your position up. How would you do it again? How would you create a new water line above? What you sell, what you buy, what you bought, buy what you sell, and then you create a new water line. Boom, 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 boom. Buy a put, sell the call above it. Now if the stock goes to zero, what do? You know what? Everything, you don't lose any money. But what you're doing is you're managing a position versus just putting it on and letting it ride. Now, as you become more experienced, as you go up the learning curve as an options trader, managing the position increases your rewards dramatically once you learn how to make adjustments, manage them, and things. And I know there's a learning process. First, you got to get used to the thought of what even a call and a put is. Okay? Then you got to work your way onto a few trades. Then you got to work your way a little more. Then you get a little more aggressive and you start realizing that, hey, this is not as hard as I made it. And then I got to learn how to manage my positions, which is what we do at our advanced classes in Vegas, is teach people how to manage their positions, because people will tell you that your returns become more dramatic when you're able to manage your positions. Okay, where if I look at my portfolio, which we'll talk about a little later, it's basically short-term trading, which I enjoy doing. It's a lot of fun, and I'm doing certain types of trades. I got medium-term trades and longer-term trades on. I got 3 sets of trades on, and the bottom line is that I may lose on some, but I'm not going to lose on all of them, and that's the way that I trade. Rarely is it just one position. I know you guys have to start with understanding, well, let me just buy a put, let me just buy a call, let me just do this, let me do that. But as you go up the learning curve, the types of trades you put together become more sophisticated. Calendar spreads are phenomenal trades. However, there's many versions of calendar spreads that we created, which we do versus just the standard calendar spread. Way over there. Well, that's what I already said. If it was going down on the other example previously, what do? You're moving the water line down. Okay, so if you started with a 50-65 50-65 collar, the stock goes to 35. I keep the stock in place. The put that I own, I would sell, take my profits off the call, and it would basically be a wash. However, actually, if the stock's going down, you're probably making money, believe it or not. Why would I even say that? Why would it won't be a lot, but why would that happen? Yep. Oh, what you're saying is, can I make it a downside collar, a bearish collar? You know what? The only problem with that is it's gonna be hard to buy. What would you do to do that? Okay, let's say you want to put a bearish one. You would sell stock. What else? Buy calls, sell puts. That's what it would be. The only problem with that is, since a stock can only go to zero, this put premium probably won't cover that call premium. That's the difference. If you can find it, it's great, because then you can do the bearish side of this trade. That's the only issue that you're going to run into, is that it's hard to find one covering the other, where on the upside, the one I'm selling can go to infinity, so therefore it's going to have a much better price. So, and the reason we're even stating this is, I'm even giving it to you at this level, and I know it's a lot to swallow. I mean, without any question, it's a lot to swallow, especially if you've never seen this before. But what you've just seen here is as sophisticated as you could ever imagine on Wall Street. I can tell you, it's sophisticated stuff where I sit down with banks and we talk about this stuff. I mean, this is sophisticated stuff, and you're seeing it on the second day of this course, which is should take you to the next level. Hopefully, a lot of you guys, even if you can't come to Vegas now, you're going to see us there at some point, even if it's just to go to the buffets. But actually, Tom, someone just got an email from Tom. You have that email up somewhere? Someone just took our class in Vegas, and he just sent us a really nice email about how much he made as soon as he walked out of that class. So, I mean, it was just kind of interesting that we get that a lot. I mean, we get people calling us saying, hey, I'm doing great, or, if I'm giving a speech, a lot of times I do a speech at the money shows. A lot of our students are there, and they come up and say, you can't believe what I've done. It's just nice to hear those things. I mean, it's really great to hear.
This was an interesting one. Somebody on our discussion boards tried to get the Tarzan and Jane trade from a guy who took the advance, and the guy who took the advance says, no, you got to come to the advance. And he said, I'll tell you what I'll do. And this was on the discussion board back and forth for a couple of days. Guys, I'll tell you what you do. As soon as you sign up for the advanced, I'll call and make sure you signed up, and then I'll tell you the trade before you get there. And the guy made $9,000 on the Tarzan and Jane trade before he even showed up our class.
Oh, really? Okay.
Yeah.
All right.
And this is actually out there on one of the posts on the discussion board. It was funny because I was watching it, and I was wondering, is that guy gonna cheat and share the information with someone who's who hasn't paid yet? But he didn't. I was really impressed.
We don't like cheaters. We will find you. Okay. The funny thing, it's a small world in the world of options. You think it's big. We know everybody. We will have the Optionetics police. No, but we appreciate that a lot of our students, I mean, they appreciate how much work and effort we put into this. And, we get a lot of students, and I really appreciate it, who realize that we don't have to do this anymore. And, we actually enjoy it. And believe it or not, the 2-day courses as well as the advanced courses, Tom and I do it not only because it gets kind of boring just sitting in front of a computer all the time. And one, we get to see all the people who work for us. We touch base, and we enjoy ourselves. But it keeps us on our toes too, because we get to think on our feet. We have some pretty smart cookies out there who are always, bombarding us with ideas or giving us new ideas. And we have a rule that if you create a trade we've never seen, you can name it whatever you want. So that's how Tarzan was invented. And then that's a true story. Phil invented Tarzan because it looks like a swinging vine. And it does, and then I added the Loves Jane because I added a piece to it. And that's actually what happens. We get people who we come in, we share an idea on, hey, here's a trade. And then, for example, a lot of our advanced students will keep coming over and over and over again. And they'll say, hey, I tried that and then I tried this. I tried this and then I tried that. And it's actually sharing ideas, which, we like to do. And my instructors are really bright people. I mean, every single one of them know this stuff. And, we like to share ideas even with each other. So hopefully you'll be there one day. More importantly, for right now, I want you to understand what a single stock future is. I think it's going to be the best product out there. Remember, I'm saying this theoretically because they're not out there yet. But if you can do what I think is going to be able to be done, it's going to be a phenomenal way to, and I can tell you, I'll be able to find 100% return on my money risk-free probably every single day. You're going to ask me how often these are going to come out. I bet you every single day I'll be able to do that. So, and once again, it's going to be a great way to manage your risk. Yeah, I had a couple questions. Yeah, go ahead. No, you wouldn't be selling the naked put because you have a short stock. Okay? It's just like if you own a futures, and you sell a call against it, you're really not naked because you've got an asset. Remember that little thing I said, you got an asset, you sell something, you can sell a put against it. You buy something, you can sell a call against it. Okay? So that's not the issue. But go to onechicago.com and you're going to learn something about single stock futures. Okay, one more question and I got to keep going. Go ahead, Pete. Go ahead, one more.
Okay, stop the confusion. You can sell a call against a piece of stock, against the same piece of stock. You can also sell a put.
Yes. Correct, yeah. I mean, what happens is if you short something, you can sell a put. If you buy something, you can sell a call. But remember, what we have given you here, guys, is ways to do things very carefully. When you leave this class, and Tom's going to go through a little summary, and then I'll do a summary. If you leave this class and you find, you can read other people's books, you can listen to other people, and there are a lot of people out there who still teach selling naked options. And if you ever see someone who says, sell naked options, it's the way to financial freedom, that's a bunch of BS. They don't know what they're doing. I'm not going to mention any names, but you can go ahead, Pete, if you want, but I'm not going to mention it. The problem is there are a lot of people who years ago thought, hey, we're going to teach people how to do this, but they're not real traders. Tom and I have seen people make tons of money. We have seen people lose tons of money. What we're telling you to do is not to do those things where people lose money like there's no tomorrow because they do something stupid. Everything we've taught you so far is very safe, and we're going to keep it that way because that's the way we trade. You know, I do not like taking risk, and I know you guys don't, and you know, you just got to get your knowledge level up, which is what you're doing here. One more question, then I'll give it to Tom. Yes?
When you adjust a collar to the upside, do you have to put some more money into the trade? Because it would seem like you can't buy back the old call and sell the old put for even money.
Okay. What happens is, the question is, on an upside, are you putting more money? No, you're not, because you're making it on the asset. Okay? So the whole point is, you make more on the asset than you lose on the put than you lose on the call. The whole point of it is, something's going to lose money in a spread. It's just the way life is. But no, you wouldn't have to put more cash into it. No. No, because you're making money. Okay, you're making money on the upside. The stock is going, it's like the delta neutral trades. The stock is going up dollar for dollar. The puts are only losing, they're not losing dollar for dollar, they're losing a portion, and the calls are losing a portion. As long as you make more on one leg than you lose on the other two legs. That's the whole point of our trading. What's that? The downside, what's happening is, on a delta basis, since you're going to have an in-the-money put, at one point you're going to have an in-the-money put. An in-the-money put is going to move dollar for dollar with the stock. Just like a calendar spread. If you do a calendar spread today, what happens on a calendar spread, let me just give him this a second. You do a calendar spread and it goes against you. Let's say I sold an Intel, whatever, 17.5 put for August, and I buy the Intel 17.5 put for September. If the stock breaks down and you get assigned stock, what happens when you sell a put? Let's say I did 10 of these. What would happen? The stock goes to 12. Okay, at expiration. It blew through my position. You're going to have to now buy stock at what point? 17.5. Okay, so you had to buy it at 17.5, the stock's at 12. But now you have this put here still, okay, which is at 17.5. Okay? So what you have now, what's called an in-the-money put with the stock below it. When you have that going on, the only risk is whatever time value is left in your put. This is a very safe trade, by the way, and trading commodities like this is a good way to do it. For those of you who trade commodities, you know, you can buy an asset and have an in-the-money put. The only risk is whatever time value is left in the put. So if you don't want to have any risk, what do you have to have? A put with no time value. And I know this is going to go over a lot of people's heads, but I want you to think about this as you leave this course, because what happens is, and I know I've done this a long time, a lot of you, there'll be a group of you in here who will say, hey, I'm starting to get that. What was he trying to get at the point at the end there? There's certain secrets we're giving you that will give you clues on how to be more successful, and hopefully the light bulb will go off. But once again, if you're even coming close to understanding what I just did in this last hour, I mean, you're smarter than most people out there who are trading. I'm telling you, this is sophisticated stuff we just gave you. I'm going to give you my reading list. This is what I would do. A couple books I'd like you to read beyond what we have done. Okay. First book is called The Options Course. Guess who? And second one is called Trade Options Online. Guess who? The third is called The Stock Market Course. Guess who? And then we're going to have a fourth one coming out pretty soon called the Volatility Course, which is going to be a great course. So, and how to understand volatility. Yes, we can shamelessly promote because we're up here and we have the microphone. The next book is a book called The Market Wizards, which is actually one of the best books out there. There's two of them. There's one called The Market Wizards. There's another one called The New Market Wizards. This is probably the one book that influenced me the most. You know, other than, you know, this is before I even knew what I was doing. And this book, basically what they do is they interview people who are, you know, very good traders, and it gets into their heads as to the psychology of trading. And I hope that every single one of you read this, because what you're going to learn is that every single person has gone through some adversity because they had to figure out what they were doing. Eventually they said, I'm not going to give up, I'm going to keep fighting until I learn this. And then eventually they learn what they're doing. And I guess the biggest thing that they all tell you is you need to manage risk. We've been teaching it for days. How many of you read this book already, The Market Wizards? Great book. You got to see it. You know what? Read it 10 times if that's what it takes. Because I know a lot of you are going to walk out of here. You've got a ton of information. You may be frustrated at times. Oh, this is too hard. It's too difficult. But you got to remember, we have just given you years and years of our information in 2 days. If I sat through this class without having seen an option or even knowing what an option is, I would be feeling exactly like a lot of you. I'd be saying, you've got to be kidding. That's just so much information. But you've got to remember, you're being educated to probably be the most profitable business left out there. You don't have to have employees. You don't have to do anything. You don't have to have inventory. One of our students recently came to a class from an overseas country, I won't tell you, and it's amazing. He wants to learn how to trade because there's so much risk in his company, political as well as terrorist risk or whatever. He's like, I got to do something else for a living. I mean, so everybody's got a different objective to come in here into our classes. And, we want you to understand that. That's a good book called The Market Wizards. Intermarket analysis, John Murphy will teach you about gold and silver, how the interest rates play with gold and all that stuff and how they go into the marketplace. Pit Bull. Marty Schwartz was one of the best S&P futures traders around. It'll give you a good idea as to his thinking, his mentality. And let me tell you, the one thing and I'm going to stress this, that every other successful trader that I've ever seen, the reason they became successful is they never gave up. I mean, that's an important thing, so please never do that. Futures. Larry Williams is a really nice guy, and he's one person I know actually makes money trading. You got to be really careful. There are a lot of people who write books or teach courses, and they can't, make any money doing trading for themselves, and I can assure you this is what we do for a living, okay? Next book is a book called When Genius Failed. This is a good book about a company or a group of partnership called Long-Term Capital Management. Who's heard of them before? Okay, these were some of the smartest guys got together, including Nobel Prize winners in options pricing models. They got together, raised $3 billion in probably a few weeks, right, to trade in the markets. Then what they decided to do is to create these systems that they're going to follow. They leveraged themselves from, I think, from $3 billion to $1.2 trillion. That's a lot of money, okay? That's a lot of leverage. And then these guys who are very smart people, some of the smartest people in the world, did something that we tell them not to do. Sell naked options, okay? And they lost so much money, it was scary. It brought our U.S. markets down. A lot of people a lot of banks have invested with them. I mean, there was a scare going on where Greenspan had to get involved and people were trying to get Warren Buffett to buy them out and to save them. I mean, it was a big mess, but basically what they did is they sold naked options. Was their biggest thing they did wrong. And these are not stupid people, so what I want you to do is realize that they did something stupid even knowing, well, they should have known most of the rules. And these are not, these are really, really intelligent people who just did something really stupid. Now, there's a video called The $1 Trillion Bet. You can get it off our website. It's a great video about this whole thing, all right? Great video. I mean, it's fascinating, and they talk about how options pricings were put together and this and that. I know that sounds boring for some people, but it really wasn't. It was kind of very interesting how this came about. Okay, so these are books that I like that I would read right now. Just be cautious, like Tom said, when you're out there, and absorb as much information as you can. There's a lot of websites that are going to tell you a lot of garbage. There's a lot of people teaching garbage. There's a lot of people writing books that's garbage. And the problem is that a lot of you still don't know that. So if you ever see anybody saying something contrary to what we said, it probably is garbage. Not to say not to absorb other people's information. We'd love you to do that. We did that when we first started the trade. But realize that you did take an incredible course here. You got more information than you could ever imagine. You're learning from people who do this for a living 100% of the time, and we trade very sophisticated, and we know as much as anybody else out there, if not a lot more. Okay. Now I got a few new books added to my recommended reading list. Okay. Okay. Those were interesting books I just saw. But anyways, I was going to add a couple others, but I didn't want to actually. So yeah, question.
So we got 4 books that came with this course.
Yep.
Does that material
okay.
overlap
No, what happens is a good question. This stuff that you've sat through, plus the stuff that the videotapes, whatever, is the most comprehensive stuff you're going to get. Okay, the other 3 books, which you can get very inexpensively, you're going to get a few more tidbits, maybe a few more case studies. But no, what you have is beyond comprehensive. It's just, we like to sell more books, so we have to tell you. So. Believe it or not, you don't make a lot of money selling books.
I think it's more of an ego trip, yeah.
Yeah, it's more of an ego trip. It's certainly not a financial rewards, that's for sure. But it's kind of interesting to go to like Barnes & Noble and see your book there. And then if somebody's reading somebody else's book, I say, no, that's not a good book. This is the one you got to read. That's what we do, actually, when we're not here teaching. We sit at the bookstore waiting for somebody to look for a book. Let me just to break it down. That looks pretty like a cool diagram, Tom. Going in another way to look at this, I kind of want to just review the course a little bit, because I know you've sat here for 2 straight days, and it's going to be a lot of information. In essence, all I'm going to do here is just go through a brief overview of some of the strategies we went over. We first went over debit spreads, which are just like buying calls and buying puts. All right, that's the simplest strategy for you guys to start with. Remember, when I used a 5-minute success formula in most cases to identify those. You can use the advanced get product or whatever products you have to identify opportunity. Bull call spreads, right now is not a great time to do the short-term ones, but longer-term bull call spreads is probably a good thing to do. Bear put spreads is a good time to do bear put spreads because of the way the market's been acting. Okay, in a debit spread, typically, where do you want volatility to be? Low volatility. So typically you're going to want volatility to be low. Once in a while, you know what, you got to say it's volatility's high, but I don't think it's going to go down. I think it could get even higher. So it's a call sometimes, even when you look at charts. When I looked at Tyco, the first time Tyco broke down, I'm like, volatility is high. What do you think happened to volatility? It got even higher. And luckily, you put on trades that don't hurt you if that's going to happen. Credit spreads, you're typically going to do during a higher volatility period. Because if volatility drops, you can basically make more money doing that. Okay? Basically, with just a volatility drop, you can make some money. Ratio back spreads. So those are the credit spreads, which are bear calls and bull put spreads. Ratio back spreads, you got call and put ratio back spreads. When do you want to do those? Low volatility. Straddles. A straddle means it goes in both directions. Obviously, you can make it either direction, low volatility. But if you're going to do straddles, whether you've got our publications or not, you should have a reason why it's going to move. Okay, there's got to be a catalyst somewhere, whether it be earnings or whatever it might be. There's got to be a reason that volatility is low, you expect it to get higher. So find a reason for those to happen. Calendar spreads. Where do you want volatility to be? Typically, you want high vol in the front month, lower vol in the back month. What we mean is the front month is the closest one, the back month is further away. Lower vol, back month. What is the volatility skew we're usually looking for? 15%. Okay? Now, the way that's going to happen typically is when stocks are breaking down dramatically, you're going to get the volatility skews because, as Tom told you, what happens is if something starts to fall tomorrow dramatically, the floor traders and most traders think about what's happening in the next 30 days. They're not thinking about what's happening later on. So you're going to buy calls if you expect the market to go in which direction? Buy puts if you expect to go which direction? Down. Bull call spread, you expect it to go up. Bear put spread, you expect it to go down. Bear call spread, you expect the market to go which direction? Down. Bull put spread, you expect it to go up. Just look at bullish or bearish, bullish or bearish, bullish or bearish. Okay? Call ratio back spread, you expect it to go up. Put ratio, you expect it to go down. And the straddle, you just expect it to move in either direction. And a calendar spread, you expect it to go which way? Sideways. Or you want it to go sideways. So you can kind of see that you can take one bullish trade, put it on with a bearish trade, put it on with a sideways trade, and you start creating funkier, we call it a funky looking risk graphs, which creates the types of trades that as you become more advanced, you're going to want to understand. Not necessarily just to put on one trade and then hope it goes in that we've Let me tell you, we've been doing real well finding market direction. I mean, we obviously have a good tool, we feel comfortable in it. it makes, if you've got a great tool that makes good money going in one direction, you feel confident with it, there's nothing wrong with just buying calls, buying puts based on what's that saying. The other stuff actually is great because you can start blending things. For example, volatility, if you put a straddle on the same time you put a calendar spread, one makes you money if time decay is in your favor, the other one hurts you with time decay. You can start learning how to balance those two together. You can put on a bullish trade with a bearish trade. You can put one on that if volatility gets higher, you make money. You have put one with volatility gets lower, you lose money. And you can start blending things and make it better than just buy a call, buy a put, buy a call, buy a put, which is just your normal place to begin. I mean, a lot of people are going to start that way, but we hope you look at all the other ways, which are a little more sophisticated. So the bottom line is that, when I'm putting on my trades, I would say that, like Tom said, a majority of my trades are probably in the calendar spread type family. And the reason I say the family is just because I know how to take a calendar spread and then turn it into a bunch of different things. So I can be very creative in the knowledge that I have just because I've done this a long time. It's obviously what we teach or whatever. But you guys can start with a calendar spread. You can put on a straddle, which is a different type of trade. Remember, never sell naked puts, never sell naked calls. It's a major, obviously one of the most important things to do. Now, the other thing is just last but not least, I urge you guys, especially those of you here for the first time, you have to take a day's break before you start thinking of this again. You got to let your circuit breakers turn on again. I realize it's tons and tons of information. And like I said, this is what professional floor traders deal with. And this is what they have to know. So you're trying to make yourself a professional options trader. Learn how to use our website because the website is just phenomenal. Whether it be the free site or the platinum site, I don't care. If you really dig into all the information we have, it's just unbelievable. If you can make it to one of our classes in the future, one of the advanced classes, whenever it'll be, we'd love to see you in Las Vegas or wherever we're holding them at that point, because it really is a lot of fun. And I regret we can't get to know everybody in a class, certainly in a class this size, but certainly at one of our advanced classes, we can try to get a little more personal because there's just smaller groups and stuff. Feel free, last but not least, I always want to say, feel free to see every other instructor we have, because I certainly won't be teaching every class, and Tom won't be teaching every class, but I got a lot of smart people, and it's really good to see everybody's different perspective. Tom and I can trade very differently versus some of our other instructors, but the bottom line is we can all make money because there's so many things to do. Last but not least, let me say thanks to Tom, because Tom's been a great co-instructor for many, many years. And, it's just wonderful to have somebody that I can work with. I don't have to worry about what he's saying. He does a great job. Anyways, thanks. Last but not least, I want you to congratulate yourselves, because what you've done is you've taken an incredible step to hopefully will be some life-changing rewards in the future. Thank you very much. Thank you very much. I'll be back someday soon. Talk to you later. Thanks.
This concludes CD number 15 of the Optionetics course audio series. Let's review some of the most important points covered on this CD. In this session, George Fontenilles introduced a protective strategy called the collar. A collar strategy is composed of owning 100 shares of stock and the purchase of an at-the-money put and sale of an out-of-the-money call to protect it. Although the reward on a collar is limited, it also serves to limit the losses on the stock. If the underlying stock falls significantly, you may want to consider moving the waterline by offsetting your original options, i.e., selling what you bought and buying back what you sold, and then redo the collar at the new price. If the underlying asset rises significantly, you may want to raise the waterline by offsetting the original options and buying another at-the-money put and selling another out-of-the-money call at the new underlying price range. George also introduced single stock futures as a new trading instrument that can enable traders to control stock for less money. A single stock futures is basically a futures contract on a stock. A new exchange called One Chicago will be the main exchange for single stock futures. Traders will be allowed to trade single stock futures from a stock or futures account. For more information, check out www.onechicago.com. optionetics.com. George's reason for mentioning single stock futures is to alert you to the fact that traders will be able to substitute them for stock in strategies like the collar strategy. This will reduce the initial cost of this kind of trade and the overall risk. So, when single stock futures hit the market, you may want to consider buying the single stock futures, then looking for puts that cost X and selling calls against it that cost X. And then you will have completely hedged your trade for free. Tom and George conclude the seminar by going over a few final issues. All in all, they recommend the following points. Become a specialist in one or two strategies or in one or two sectors. To place a trade, determine market direction, look at the options, check their implied volatility to determine if they are underpriced, overvalued, fairly priced, or exhibiting volatility skew. Then decide what kind of time frame, short, medium, or long term, is best for the market scenario. Ratio backspreads are long-term strategies using options with 60 days or greater. Medium-term strategies include vertical debit spreads, i.e. the bull call spread and the bear put spread, straddles, and strangles. Short-term strategies include butterfly and condor spreads, calendar spreads, and vertical credit spreads, including the bull put spread and the bear call spread. And finally, 1. Research all aspects of a trade. 2. Always write down your order before you place a trade. 3. Never risk any more than 5% of your account on any one trade. 4. Don't risk more than 50% of your whole account at one time. 5. Never leg into or out of spreads. 6. Always place spreads as a limit order. 7. Use all the tools at your disposal before placing a trade. And 8. Always continue to educate yourself. This concludes the Optionetics course audio series. We hope you found this series to be educational. It can take time until all the many pieces of trading fall into place. But repeat seminar attendance can encourage you to learn at your own pace, just as listening to this audio series again and again can reaffirm trading techniques and bolster trading confidence. It's up to you to use this information to develop profitable trading experiences that garner consistent profits. Start small. Specialize in a few markets and keep working with each strategy methodically. You have the tools to become a successful options trader. Cultivate patience and perseverance, and you'll be on your way to an exciting career in the markets. From all of us at Optionetics, good luck and great trading.